previous class, and I know that I have to show you the normal table that I will able to show you by 9:45 or 9:50 once we complete this session. Nothing to worry. If anything is troubling you from the last session, please do not hesitate to post your queries. We'll take it up at around 9:45 to 9:50 and make sure we are resolving all your queries. So before we start, your regular questions. Number one, sir, from where do we download this slide? So I'm just sharing you the link from where we can download this slide. Secondly, is it applicable for the old and the new course? Absolutely yes. Okay, but the pattern of teaching shall be purely as per the new study material, which is designed for May 21. But this same topic is applicable and was applicable in the old course as well. So those who will be appearing will also be beneficial for this course, for this chapter, I mean. And today's session will be absolutely practical. I have tried to incorporate a lot of other things which you might be looking at the PPT, which is not available over there. So once I prepared the PPT for the students, because that is all notes based, and then I add few more of my points so that the class becomes a little more interesting and participative. Okay, so let me share the slide with you, students, so that you can just see that. Okay, great. Okay, so firstly, before we start, let's give the credit to all our BOS team members who has been very active in their job that they are doing. Okay, so let's start. This is the link that you can see. Okay, so you can download the PPT that will be in the PDF format and the assignment. I'm sharing the link, and I would definitely pause it for about 5 seconds, not 5 minutes, so that you can just note it down and you can start with that. Okay, any queries, please post it. Your PPT, which is available, made available to you for the download purposes, are being uploaded much more time lesser than the class, almost a day before. So they are making tremendous effort. Please make sure that you are downloading them on a timely basis and looking at them before you come to the class to attend this virtual coaching classes. Okay, assignment is also downloadable, but that will be applicable for the next class, which is supposed to be held on Thursday, right? So are we good to go, students? If you have noted this down, okay. I hope you can see the board, everything. So I'll just give you a glimpse as to what the chapter is all about, and then gradually we will start doing it. So I think you can log in there, live.ica.org, and the BOS. You have to put your details, your normal registration number and all, and you'll be able to download the material, right? Okay, let's go. Let me just stop sharing, and I can give you the full board access so that you can see as to how the things will be in this pattern. Okay, so let's see this. So this is your chapter, which is security analysis, which consists of two topics. Number one is fundamental analysis, and your technical analysis. My PPT preparation and my teaching will be totally practical based. It's about that, unless you don't learn it practically, you will not able to write something in the examination, right? I mean, once you've seen the things practically, and then you are able to apply that in your examination as well. I mean, this is the purpose of ICAI's articleship as well, that when you see your auditing standards, Companies Act, income tax, all those acts in the real life, I mean, the practical life, then it becomes very easier to pass the paper. Similarly, also, I will try and put it this topic today, most probably, if the coordinations is maintained, and therein we'll see what all things we are supposed to study. Okay, so we first discuss about the fundamental analysis. So here you are supposed to take care of the things that once you buy a security. Okay, so buying a security. So you have to analyze whether it is worth buying or not. Okay, so let's say you are about to spend 1,000. Let's say 10,000 in a security. Security means any company's share, any company's debenture, any company's preference share, or in today's scenario, on a simple words, is like just simple mutual fund. So even if you want to, put your money in a mutual fund, You want to see that whether it is worth buying or not. So how do you see that? What all criteria are there? Whatever knowledge you have in the earlier, from the earlier times, in the sense that till you have not taken this session, then you will now see the things from a very completely different perspective. And before you put in your hard-earned money, you will definitely think twice that whether I should go for it or not, because there has been a lot of scams in the Indian market and as well as in the world. I mean, nobody is a clean person, definitely, but we have to just see that whether are we intelligent enough to put in money somewhere where we trust those guys, and we have a confidence that our money will not be lost. Guys, if you're thinking that, sir, we haven't analyzed any security or anything, let's talk about especially our female students, because whenever they want to buy any of their clothes, okay, because they have a greater variety of the clothes, as we all know. So whenever they go out of the market, so let's say they go to a shop and they see a very good dress, okay, which they get mesmerized that I want to purchase that particular dress. How do they think, okay, that whether we should buy this dress or not? They look at the color, they look at the fabric, they look at the making, they look at the brand, definitely. So they look at a lot of things, and then they see last the price tag. Okay, so let's say the price tag is something which is acceptable to them, so they buy that particular dress. If that is not acceptable, they'll have two options. Either they will look for the discounts, that is for sure, if some discounts are being offered, and secondly is that they might just reject it, because might be they don't have that budget. Similarly happened in this case as well. Whenever we are supposed to buy any security, okay, so first we analyze different criterias over there. Just like as I told you in the dress, we have the fabric and a lot of other things. In the same way, we always see in a security that what is the return that they will give me. At the end of the day, the bottom line is only one thing, that is the return. So return can be in the two forms, which can be in the form of capital appreciation or in the form of dividends. Okay, I'll touch base both the concepts in 2 minutes. So that is the first criteria. So how to look for that criteria is you have to see what is the dividend that they are paying, what is the industry analysis, what is the sector analysis, what is the company analysis. So all these things are carried out, and in the company also we see a lot of things. Today I have given you a lot of material. I mean, I will be sharing here today, not on the BOS portal. So you will have a greater understanding, and I can assure you that you will have a greater kind of a retention as well in this. Okay. So why do we buy a security? Let's understand. So buying any security has two purposes, two reasons. Okay. The two reasons are, number one, capital appreciation. Okay. So I am buying a 100 rupees stock. Okay. It becomes 150. So 50 rupees is my capital appreciation. The example that I gave you for the dresses, okay, will not stand valid at this point. Why? When we buy anything which we like, okay, we buy a mobile phone, we buy a good dress, we buy sports shoes, whatever. That's part of our luxury. Okay, so that's part of our satisfying our utility. Okay, so we are not generating any return from there. When we are using it, when we are wearing it, when we are using the mobile phone, it gives us a pleasure. I mean, in the sense that, okay, our money has been deployed over there. But that is not the criteria in case of a security analysis, right? Because when we buy a security, the only bottom line is that we need some kind of a return. So return can be in the two form. Number one can be the capital appreciation, means I am buying a security today, which costs, let's say, about 100 rupees. After 3 months, 5 months, 1 year, 2 year, 3 year, if it goes to 150, so 50 rupees is my capital appreciation. Now, till how many years you want to hold, that is purely your decision. If you think that the company's fundamentals are strong enough and you can hold this stock for a longer time, so you can hold this stock. Now, if you think that the company, when you entered the stock, okay, listen this carefully. I hope you'll get my point. When you entered the stock, the fundamental of the company was good. And then gradually it starts to deteriorate. Okay. As a result, then you get to know that I have to take my money out of it. Right. So analyzing a security, I have not even started fundamental analysis, students. I'm just telling you a very simple fact. Abhi ke liye, The fact is, when you buy a security, you are just first analyze that whether I should enter into enter into it or not. And once you've entered it, after fulfilling the criteria of the fundamental analysis, which we will study in today's session in next 3 hours, if those satisfy that, then you enter it for the purpose of doing a capital appreciation in your investment. Okay, everybody needs something. And the second important reason is your dividend. So dividend is something which is paid by the company after declaration of the results. So every quarter the company declares its results, and they specify the number of amount of dividend based on the number of shares. So let's say you are holding 100 shares. So they say we will pay you a dividend of, let's say, 7 rupees per share. So automatically you will get 700 rupees, right? You're getting my point. So dividend means that it depends on the number of shares that you issue. They put that figure in front of the shareholders. They approved it, and they decide a record date. That date in which you need to have those shares in your DP. What is a DP? That is your the depository participant. You should have those shares in your DMAT before the record date, and then by 7 days to 10 days you get the dividend in your bank account these days. So time has gone where definitely your parents must have been investing, and they are used to get those checks and everything from the companies. It used to come from the postage. So that time has gone now. Every dividend comes in the bank account. Similarly, it happens in case of the dividends as well. So just in case you have invested in various schemes, they also declare the dividends on a quarterly basis or half-yearly basis, and then they gradually pay you. So the only motive to do the investment is two things. Number one is capital appreciation. Number two is dividend. A lot of students get confused that, sir, when we are buying something, it doesn't give us dividend. Or doesn't give us the capital appreciation, like mobile phone. Mobile phone is never a security. It's absolutely a material of satisfying your utility, right? Your pleasureness to use a smartphone, to use a 48 megapixel camera, all those things. But that is never constituted as a security, because security, when we buy, you have only two motives. That either you want to enjoy the dividend from here. It could be a final dividend. It could be a interim dividend. It could be a special dividend as well. So what all these dividends are, we'll be discussing in the going forward session, just today itself, don't worry. So dividend can be in any form, and capital appreciation is something that when you buy a particular security, you need to hold that security for some time if the fundamental of that companies are good, and then gradually you can start getting the returns from there. Okay. So I'm sure if your father knows, or let's say your mother knows, or any of your relatives who are a little elder to you, so if you have invested certain amount of money in good companies like HUL, Infosys, Eicher Motors, they've given a tremendous return. Okay. At the same time, I am not inducing you to please put your money on in any of the equity, because it requires a thorough research. So until don't you become a complete chartered accountant, means you complete your studies, you complete your articleship, do not enter into this market, because that can leads to deviation of your interest in the work. Yeah, if you have current some saving, it's always good to have putting some money in the mutual fund, but using derivatives and using equity is not a good thing. For the timing, you just understand the concept, and once you'll become a CA, everybody of us from the US will help you in investing in good companies. Okay, I mean, just on a friendly side, I'm saying, do not indulge into investing. Otherwise, you can be little, tilted towards more of that glamorous area, which you should avoid until you complete your CA, right? So this request I'm telling you, I'll also put this request when I'll be teaching you derivatives. So about when we'll talk about mutual funds, then you will get to know what all a good mutual fund, how to analyze that. You can put the SIP over there, any good mutual fund. Okay, I'm not taking any name. Okay, so guys, any doubts?
It's 7:15
before we start. Okay, so there is only one query till time from this student called Lakshmi. So Lakshmi, I'll be taking up all those queries, students, which is pertaining to last class, because I know I have to show you some tables as well, and there were some other queries as well. So by 9:45, I'll end up today's session, and then I'll take up all your previous chapters queries. Okay, fine. Is it okay? How to start that? Okay, so the first step is security analysis. Two parts, fundamental as well as the technical analysis. In this, we have two reasons. Number one is for the purpose of capital appreciation. Appreciation means the value of the security or the stock increases. But it only happens in case of an equity share. In debentures, the value always remains same. Okay, are you getting the point? In debt, the value remains same. You are getting a fixed income based on the rate of interest that was given to you at the time of you are entering into the debt market. But as far as equity is concerned, they are not fixed income. Okay, they can give you a negative return, they can give you a positive return, they can give you blockbuster returns, 20%, 30%, 50%. Not surprising at all. Okay, in a year. Okay, not on in a day, in a year, obviously. So this is how the things are. We have to see that when we are buying any debenture, any debt, okay, anything which is related to the debt market, we don't find such kind of a capital appreciation in, let's say, even 1 year, 2 year, 3 year. We get something called as the fixed interest, okay, on the face value of the debenture that we have. But that is also covered under the same criteria. So even if when you're giving your money to the person who is a fundamental analyst, he also does a job that before you give your debt towards any company, you should know what is going on in the company. Okay, so it's very important to understand as to the company is doing good or not. Then only you would give your hard-earned money to those companies. Okay, so gradually you will understand whatever I'm speaking, so that it becomes quite easier for you, right? So no other queries. So I am rubbing the board and I'm sharing the slide with you. Okay, so that we can proceed to the chapter. Okay, so we are here. Okay, so I hope you have downloaded this PPT, I'm sure. Okay. Okay, so this is the first chapter. I mean, this is not the first chapter. I mean, second chapter, which is the security analysis, which consists of students, two things. Number one is the fundamental analysis, and number two is the technical analysis. Okay, so we will touch base about the left-hand side topic today, and technical will complete in the next session, right? Okay, are we good to go, students? Any doubts? Okay, so no query over there means you don't have any doubts. But even if you find it, anything challenging, please do not hesitate. Okay, although I am your teacher, I am elder to you, but unless we don't have a good friendlier relationship, I mean, in terms of concepts, then it will be difficult for you to proceed to the next concept. Okay, so please don't hesitate. That is my request to all students who are looking at these videos from the all India level or maybe outside India. So please do not hesitate that. Okay, so very simple concept about the fundamental analysis. So we are starting with the fundamental analysis. Okay, so I will not I've given the PPT for your own understanding. Okay, so I will not be using that much unless I have something to show you over there. So we'll take up the very simple thing. So as we have discussed in the first concept, which is the fundamental analysis. Okay, so there are two kind of a research analyst in any company, which could be fundamental, and there can be a technical analyst, a person who sees the charts and all. So if you think that you can do something good in this area after you complete your chartered accountancy, because a lot of people are there in this field. Okay, it's a good, highly paid industry, and you get a good money if you are researching on something, but there are criteria to do that. If you talk about the technical analyst, who are the chartist who sees all those trends and patterns, which I'll be teaching in the next class, they're also there, but the ratio generally is 4:1 or 5:1. In the sense, there are fundamental analysts more in quantity as against the chartist, because chartist has a very normal pattern. This is a very wider scope area that you need to see that. Okay, why I know all these things is because I have during the time I was into this job, I was into employment, I've been part of a CFO as one of the leading mutual fund company. So I know all the in and out. So rest assured, this has more legs to broaden up and understand the concept. Okay, so fundamental analysis is based on a very, very simple assumption. Okay, so it says, number one, whatever share price is there. Okay, let's say it is 100 right now. Okay, let's say the company's name is ABC Limited. Okay, so it says it depends upon going to 150 or coming down to 80. depends on only one thing, is the future dividends. Okay. In what form the company pays the dividend? It could be interim, it could be final, and sometimes it could be special as well. So a lot of government owned companies, how does government own it? The shares of those companies are held by the president of India, right? I mean, our president of India, of our country. So they are holding shares in those companies about more than 50%. So as a result, they generally go for buybacks, they generally go for special dividends, all those things that are happening over there, right? So this is how the things take place in terms of dividends. Okay. So it says the share movement, okay, the pattern, the upward or the downward trend depends upon the future dividend, and who are the people who expects them, you and me. Why? Because we are investing our money. Okay, so we become the shareholders. So when we give money to XYZ, okay, so this is, I know, a little funny, okay, I know. So this is me, this is you, okay. So we are going together and giving money to them. So what is basically our intention is that we need a good return, and return has how many forms? Two forms. One is the, repeat with me, repeat. I know I can't see you, but you have to repeat with me. The two reasons is, number one, capital appreciation. Number two, the dividends. Dividend can be in the form of interim, final, and special. We don't care. In the sense, till the time we are getting good money, it doesn't matter to us in what form are they giving us the return, right? Simple. Okay. So basically, the future price, the price, the assumption that the price depend on the future dividend expected by us, that is the shareholder. So how do we calculate the present value? Okay, so we discount that dividends with a appropriate discount rate. Okay, so the future dividends are thus discounted. Okay, they are discounted. किस पे? At the discount rate. Okay. Sir, why are we discounting it? This could be your question. Because we are not getting the money today. We are getting the money in next 2 years. So just like this is you and me. We started in 2020. This is a year which is going on. I know, little this thing. Unlucky for all of us. So let's say we have invested for a duration of 3 years. So 3 years kahan khatam honge? It will be like 21, 22 and 23. Okay. So dividend that we are getting over here. So the amount that we'll be getting in 23 will not have the same value as we are at today. So what we are doing is, students, we are trying to do the present value of the future dividends by discounting with the appropriate discount rate. Now you will say, that sir, what is this discount rate? This is beta nothing but your cost of equity. Now your next question will be, sir, is this cost of equity that we studied in CA Inter? Yes, absolutely. So cost of equity, if you remember, we are calculating with two methods. Number one is the CAPM, and number two is that Gordon discount methods and all those things. So this is the same, but rest assured, in your CA final, they will not again give you to calculate cost of equity, because that is simple, that you already covered in CA Inter. So now you are doing the application of the concept that you already studied it. Okay. So we discount this particular future dividends with a discount rate, and the value that we get. Okay. See carefully, guys. I hope you are with me. Not sleeping, right? So when we see the discount, okay, the future dividends, and we have discounted it, the value that we get is the intrinsic value. I hope the spelling is correct. Okay. Yeah, intrinsic value, right? Means the real value according to you. Okay. Sir, we have not heard this term earlier. That's not the case, students. You have heard it. You have heard it numerous times, and you have heard it even when you are matured enough. You go to the shop, okay, let's say a street, in the street, because generally, the shopkeepers doesn't give you discount. So let's say you like something, Okay. And you say, what's the price, bhaiya? So he said, bhaiya 50 ka hai. Bolega, didi, I mean, it's for 50 rupees. He said, no, I'll not pay more than 30. What did you say? Sir, bhaiya, I will not pay more than 30. So from where did you get that 30 value? Because you calculated that value in your mind. You calculated that value in your mind, that whatever you are looking at is not appropriate. So you define your own intrinsic value. My intrinsic value can be different. Your intrinsic value can be different. It's all about based on what thing? Beta cost of equity. I'm repeating once again. Don't worry at all. Relax. Okay? बहुत simple hai. Very simple. I'm saying this intrinsic value depends on individual to individual. Okay, so I'm just telling you, I mean, nothing related to the class. I went to a shop outside. There was a person who was selling masks. You know, these days you're wearing. For a time pass, I just went to him and said, "How much is this?" He said, 50 rupees ka mask hai. The mask costing rupees 50. Although I didn't want to purchase it, so I thought, why not to do a time pass? मैंने कहा नहीं, it's not worth more than 30. And he accepted it. I just give a very blind figure, and he accepted. He said, okay, just take it. And then he was after me. He said, you take 3, I will give you 75 rupees. So I was just astonished. This happens because this is nothing but what is the value that we calculate. Just in case you could have a larger heart and you can say, I will pay you 40 rupees. So even he would have agreed to that. It all depends upon the individual to individual as to what the intrinsic value a person is able to calculate. Okay. So for me, it was me. So me, the intrinsic value can be different. For you, the intrinsic value can be different. Why? Because the dividend amount shall remain the same. Okay, the future dividends, because we can predict the dividends from the previous pattern. In the next slide, I'll show you that how we can predict a particular dividend pattern in the coming few years. I'll just show you in 5 minutes. Don't worry, it will be really good, mind-blowing thing for you. But what all depends is cost of equity. And how do we calculate the cost of equity? If you remember, CAPM, risk-free plus beta, bracket RM minus RF. So RF again remains same. Beta will also remain same. What is RM? That is your expected return. How much you are expecting? You could expect 15%. I say 10%. You could say 12%. I can say 9%. So for both of us, you and me, the value will be different. You're getting my point? In the cost of equity, your RF remains same because risk-free, you're using a risk-free rate. You've done it in C enter, huh? Nothing new. The beta, that also remains same, the volatility of the stock. The RM is the expected return you are expecting, okay, from putting that security. So higher the risk, higher the return. So you could have it let's say percent of 15%. I could have a percent of 12%. In that case, the discounted value will come as different. So in everybody's case, the intrinsic value can be different. Okay. So for, let's say this is me, this is me, this is you. I say the intrinsic value of this stock, which I calculated by discounting the future dividend on the company called as ABC Limited, comes out to be, let's say, 95. Okay. For you, it comes out to be 105. Please see this carefully. Very simple. So I calculated the intrinsic value. This is me. This is you. Okay. I calculate this value as 95. And when I see in the market, the current stock price is 100 rupees. Will I buy it? Again, I'm repeating it. It's very simple. Just focus it. I have calculated I will pay a price of 95 for this security. And it is trading at the price of 100 rupees in the market. Will I buy it? No. Because again, that same thing mask.
It's 7:30.
Example came. He's selling it at 50. I want to buy it 30. So the price is at 100. I want to buy it 95. I will wait that if it corrects to 95, then I will buy it. Okay. Because I am following a intrinsic value. And what is the intrinsic value? It depicts the true value of share. True value. Which I believe to be the true value. It can be different. Okay. Every analyst has a different value. So if you can see the newspapers, a lot of analysts says that, by this stock price, we are expecting a target of 400 rupees or 500 rupees. How it differs? because every analyst has a different thought process. Every person will have a different true value. As a result, that is because of the this factor, which is nothing but your cost of equity, right? So if the price is below the intrinsic value, like your thought that as per you the price has to be 105, and you are getting 100, so you will buy it definitely. You are ready to pay 105, but you are getting at 100 rupees. So okay, that's great. You remember my example? I quoted in 30 rupees for one mask because that was a roadside thing. Obviously, not a branded one. I mean, just I was doing a time pass. So then he said, you take 3, I will give you at 75, means 25 rupees. So that you can imagine that if something is available such attractive price, we always go for it. Okay. Sometimes when there is a sale, why is the reason that we always rush and go to buy from from that showroom before anyone else comes? Why? Because we know that we are getting something below the intrinsic value. Okay. So this is how we determine it. It involves basically your evaluation security. How do you define its value? And you can make a buy or sell decision, or you can hold it for time till the price does not come to the value which you want to buy. Okay. So if it is trading at 100, I want to buy at 95. I will wait for this price to come down to 95. If it would come, then I will buy it. Otherwise, at this time, I will not buy this price. This is all about fundamental analysis. Is it okay, guys? Any doubts? Okay, no doubt means you are understanding the concepts properly. Is it okay? Let me just refresh it. Okay, so now, two questions have come. Okay, just 1 second, guys. We'll just take up the further concept. Just 2 minutes, huh? Okay, so let me take up today's session. Okay, I mean the topics which is from today's session. So each investor may use. Okay, yeah, absolutely. So Neil is one of the students from Mumbai. Student is appropriately given a very good statement. I would like to pronounce it in the class. Student says, sir, each investor may use different cost of equity. Absolutely, that's what I'm saying. He says, sir, every investor use a different cost of equity, which is KE, depending on what is your expectations, and hence getting different value. Absolutely. So he's put a question mark. He wanted to validate his statement. So he's absolutely correct. That's what I'm saying again and again. Say they do not use CAPM to the value. Absolutely. So to calculate the cost of equity, you remember in CA Inter, we use 2-3 models, right? That dividend discount model, Gordon model, CAPM to calculate your cost of equity. So you can use any method. If the company is paying good dividend, you will use a dividend discount model. But if company is not paying any dividend, how can you use a dividend model? You will have to use a CAPM model. That's absolutely fine, right? So it depends, beta, ki, I mean, what are they giving you? Hanji Raghuram M. Sir, price of the share is issue price or current market price? Okay. No. Raghuram, beta, this is so he's asking a valid question. He's saying, sir, this example that you given you 100, is it a current price or is it the issue price? So issue price is something which is available in the primary market. So what is the primary market? When you enter when you list your stock for the first time. Okay. So we can do this analysis for both primary market, I mean for the IPOs in which the companies are yet to list their price, okay, list their stocks. So we can try to calculate those things based on what the price they are quoting. But again, the dividend history and all those are not available, Raghuram, that is not available. So we try to use some other methods. But this price we can always frequently use in case of a secondary market, where the price are already listed. I mean, they are into the market from almost more than decades. Okay, so like blue chips like Infosys, Reliance, I mean HUL, Nestle, all those companies. So we look at the intrinsic value and see when are we supposed to buy those stocks, or we need to ignore it for the timing unless it comes to their true value. Hanji, so I think good question are coming. I hope Raghuram, I am able to explain you better. Can you give example of how you can arrive at the intrinsic value? Okay, so we are Nivedita, right? Nivedita. I'll come to that because this is part of our next topic. I mean, I'm yet to come to that. So she's so student is saying that you need to calculate this 95 rupees value to that. I'll just come to that. There's a formula and everything. I'll come to that. Don't worry. Okay. Any other queries, guys? Or I can move to the next slide. Okay, so I can give you the examples of all these things as to how you can determine the growth in this. Because in the C enter, when you are calculating, or sorry, you are not calculating, you are given the growth on the dividend. You remember that G, you are already given. But in the real life, you can calculate that growth as well. Okay, for one, where the pattern is appropriate and where the pattern is not appropriate. I'll show you both of them. Okay, that is not available in your normal slide, but I'll show you here. Okay, so let me refresh it. Okay, no other query? Sure. So let me just share with you. Okay, so you can see this thing, students. This is not available in your normal slides. This is what I have incorporated yesterday before I want to teach you. You can have a look on this. This is one of the companies which are owned by the government. Okay, means our President of India. So you can see there are 4 columns. Okay, so there's a X date, there's a dividend amount, and there's a dividend type: interim, final, and the special, as I told you during the class, right? And the record date is given. Now you would be thinking that, sir, why have you given this example? I am giving you this example is you can see the pattern of the dividends. Are they aligned? Are they aligned, beta? No. So if we go from this, it had been good. Okay, good. Then it's like something which is little not stable. So again, this is a very excellent government-owned company which is giving all such dividends. But again, we really cannot predict that how much the dividend shall be made available to us in the going forward future. So that's basically a problem. Now I show you one of the leading banks. Okay, look at this. This is one of the leading private banks. I hope you remember the private banks. I mean, not those which are government-owned. So now you can see the pattern over here, students. Just see the pattern here. 4.3, 4, 5, 9, 11, 13, 15. Okay, so all these are final dividends, right? All these are final one. This is special, so it is not countable, so we can't see that. This is basically the growth of the dividends. So we can be in a situation to calculate the growth of the dividend in any case. Okay, how can we do that? Let me just show you over here. Okay, so the dividend is, I'll give you a full board access. Let me just copy those figures. So 15, the latest final dividend. Okay, so 13, 11, 9.9, sorry, 9.5, sorry. 8, 6.85, 5.5, and 4.3. Okay, so this is a pattern. Okay, let me just stop sharing with you. Okay. Yeah, sure, Kunal. I'll try a little bit. Student saying, you can just zoom the board. Okay, just 2 minutes. Let me just push my table. Is it better, little students? Because it's a little different setup, so I'll have to, ask from you. Okay. So you can see this is the pattern of the dividends that we have. So in CA Inter, we were given a value called as this G. It was given to us that assume it is 5%, assume it is 10%, whatever, all those things were there. But in the real life, we are in a situation to even calculate this value. How? Very simple. You can just say that G is equals to simply 15 divided by 4.3 and root of, how many values are there? 1, 2, 3, 4, 5, 6, 7, 8. You take the 7th root of this. Come again, very simple. This is my dividend pattern. Okay. I want to see the growth rate in those dividends. So how we can see that? And sir, why are we working for G this time? Because the first analysis is based on the dividends. So we need to see the pattern of the dividend, right? So beta, you can do 1, 2, 3, 4, 5, 6, 7, 8. So you can take the seventh root of 15 by 4.3 by using log and all those things. Okay. But sir, wo log is very boring. Tell us something which is easy. Very simple, not a problem. You take first four. Okay. 15, 13, 11, 9.5. So you can do the 15 divided by 9.5 iska cube root. A cube root to you have in the calculator, na? That's not a problem. So you can take a cube root. Whatever value that you will get will be your G. Okay. So again, I'm saying this is not relevant for the exam for sure. Okay. Because this is something we need to understand the things practically so that we can express those things in the examination. See, examination not is just have to cram the things and put it on the answer sheets. Is that you need to understand the concept that when we are taking the fundamental analysis from the first topic, which is called as the dividend model. Okay, the based on the dividends. So how can we predict the dividend for the next coming years? As I told you, if you remember, I made a figure over here in which we had 2020, 21, 22, 23. So we are trying to predict the dividend pattern in the next coming few years. And since, as you've seen in the PPT, this company has more predictable dividend. Predictable means we can predict, yeah, this will be the percentage. So we can calculate the value of the intrinsic value based on the dividends that we will be receiving in next few years, depending on your period of holding. I'm repeating this line again, completely again. I'm saying when a company, I'm saying slowly, when a company is paying dividend regularly, like this company, we can predict the value of dividend in coming few years. Kitne years? How many years? Till the time we want to hold it. How many years we want to hold it? It could be 1 year, 2 year, 3 year, 5 year, 10 year, whatever. Whatever your age are, you are quite young. Even young than me, you can hold for a longer time. Not a problem. So whenever you can hold it for a longer time, okay, then you can discount that, and the value that you get is your intrinsic value. That doesn't come in the examination. That is not part of your curriculum. Okay, that is not in your course that you have to calculate your intrinsic value. This is a little higher level. But this will all be important for the purpose of understanding of a fundamental concept. Okay, means the fundamental analysis. Okay, so hardly you will see any question where you are calculating intrinsic value. Yeah, you are supposed to be given a value and then you have to compare it with the current market price, that whether you will buy the stock, you will avoid the stock, or you will sell the stock. Why do we sell you stock? Why do we sell a stock? Because we find the value to be completely oversold. Overvalued. Overvalued. You don't think that this is reflecting the true fundamentals of the company. Let's sell it off and let's book our profit. Sometimes it does happen. Okay, so that's the reason which is we are supposed to calculate. Is it okay? I hope the board visibility, I think, would have been even much more improvised. Okay, so thank you, Kunal, for that. Okay. Is it okay, guys? Are we good to go for the next concept? So I already told you that how the dividends can be a future play, which can be interim, final, as well as a special dividend. In any case, so we are in a situation to calculate such thing. Okay, guys? Ciao. Let me take you to the next slide. So now, as one student was pointing out, okay, so you can read whatever is given. I'll show you as to how we are supposed to do this.
It's 7:45.
Okay, so basically, our first motive is to calculate the intrinsic value. Okay. And how do we calculate these intrinsic value? It can be based or relate to the price to earnings multiples. Okay. So it will be based on price to earnings, okay, multiples. What is this PE? Market price of stock. Will it remain same or it will change? Every second it will change during the market hours. So when is the market hours? Monday to Friday, 9 to 3:30. So this will keep changing. Okay. Divided by EPS. From where can we see the EPS? Have you ever seen in the any annual accounts? Have you gone through any annual accounts? No? Okay, let me just show you. This is for one of the listed companies. So I have taken just the screenshot of the earning per share of a listed company, which consists of both basic and the diluted. So let's say the one you can see on your screens. I know this font must have been smaller because must have been a small camera. Don't worry. Okay. So let's say this price of stock is 100 and it is trading at a multiple of 40. It is trading at an EPS of 40. Okay. Uh, 2.5 will be very small. So let's do it 25, right? Let's say the stock price is 1000. Okay. Because for the company for which I've taken this, it has a price more than 1000. So it will be an appropriate thing. So how much do we get by this? Okay. So zeros get cancelled and this will be 25. So PE is 25. So if it is in the appropriate range, we can always see that this is the criteria to calculate your intrinsic value based on the PE multiples. Okay. So you should be aware that how we can calculate the EPS in the real life as well. Okay. So either we can use the PE multiple or for calculating the intrinsic value. Okay. Let me put a short form as intrinsic value. Just 2 minutes. Okay. I'll give you the full board access. Just 2 minutes. Okay. To calculate the intrinsic value or the fundamental price earning multiple, how we can use it is B. Okay, the same B which is we are using the Gordon growth model. Okay, with the earnings, O is your this thing earnings. Okay, this is for the price of stock. Okay, so earnings with the growth rate 1 plus G divided by KE plus G. Sorry, KE minus G. Okay. So this is what you have been doing in your other models, the Gordon growth model and everything. So this is basically your earnings with the growth rate. The growth we have just calculated in terms of that real company which I showed you. Otherwise, in the exam, it might be given to you just like in your C Enter examination. And as a result, you will be in a position to use the value. So whatever value that you will calculate, you will compare it with your current market price. So if it is good, then you buy it. If it is higher, then you tend to just avoid that stock. Okay, so let's say this value, because this calculation is not part of your curriculum. Okay, let me tell you very frankly, it is not part of your curriculum. So you will not be getting any values in the exam. So you are supposed to calculate this. The formula application you have already done in your CA Inter in the concept called as the equity wala chapter jo tha. I mean, I don't remember the name of the chapter, but already done in your equity when you have used the concept of the Gordon growth model. Okay, so one was a dividend discount model and one was a Gordon growth model. So you've already applied this thing. Is just an refreshment of the concept in CNDA that we will be using that same thing for the purpose to calculate the intrinsic value. But it will nowhere be part of your curriculum that you are supposed to calculate the intrinsic value. But yes, in the exam you might be given the how do you see companies fundamental based on the dividend growth model and the PE multiple. So PE multiple, you can say this is based on this. So we compare the PE of this company with the PE of the industry, and then we see is it overvalued or undervalued. Okay, what is sector, what is industry, we'll do it going forward. A lot of examples are there. and this is how we can calculate the value. So let's say the current market price is 1000 and this value gives us 750 as the value. So as per the intrinsic value, it should be at 750, but since it is trading at 1000, you will avoid this stock for the timing unless it comes down at least nearer to this price so that you can buy. At this price, you will not be in a position to buy this because this seems to be so much overvalued. Okay. This is what we tell to people when we are going for the negotiations. Bhaiya, bahut महंगा है. Bhaiya, it's very expensive. We can't buy it. You need to put some price down. This is what we say to ourselves. We say to the stock markets that please put the price down so that it reflects the true value of the company, and that's called the intrinsic value of the stock. And then we can see if it is overvalued. If it is coming out to be, let's say, 1100, so we compare with this and we say this is undervalued. Okay, so this is the only concept which is required for the purpose of understanding the fundamental analysis in the first part, that is a dividend growth model. In the exam, we don't need to have these calculations, but yes, yeah, these values could be given and you could be in a position to compare them and state your analysis as the price is either undervalued or it is overvalued. Okay, the application of this formula you have already done in your CA Inter. And again, I am not from the examiner, but it has been presumed that something which has been asked and taught in CA Inter, that is have a least chances to come in the CA final. So again, no speculation, nothing. I'm just assuming that since we have done a lot of things in your financial management also chapter and in this financial management 8A wala paper and earlier also, so they are least chances. So the understandability is only important for this chapter. Okay, any doubts, guys, before we proceed further? Okay. Sir, what is the logic behind calculating growth practically? Okay. What's the student name? Aman. So Aman, unless you don't find a growth in the dividends, okay. As I told you that buying a stock. I mean, let me take out his question. It's a valid question, and let me answer his question. It could be your doubt as well. So Aman asks, sir, what is the logic behind calculating the growth? So as I've been telling you again and again, students, the logic of putting your money in a stock based on two things. One is the capital appreciation, second is the dividend. How do you see the dividend? It's not about the past dividends, because that dividend, you have not received it. You are yet to enter into that company, right? So what happens is, you see the future trends. Means if you enter this stock right now, what is the future growth in the dividends that you will be getting? So if the growth in the dividends is 10%, it's always very good. Means let's say you are getting 10 rupees dividend right now. Next year you get 10% more, let's say 11. Third year you get more dividend, let's say 13.2, 13.1, whatever. So this is what the logic of calculating the growth. Okay. Very good question by Raghuram. Yeah. So if I pronounce it wrongly, please don't mind, because I have to see a lot of things. So absolutely valid question. Student asks, sir, whether special dividend should be considered for calculating. Absolutely not, because special dividend is, the name is called as special. That is, cannot form as a pattern. Special dividend we get because of some special nature the government wants to give you the money. So again, that should not be part of the criteria. That is why the reason that I ignored when I took that one of the private banks, so that we can use the growth in the dividend and rejecting the special dividend, because that again tends to change depending on the company's position here and there. Yeah, Kunal, I'm giving you the board access. Don't worry, I'll not rub this before I go. Okay. Okay, see, bas? Okay, so what's the question? Let me just see. Okay. Lakshmi is asking, 1 minute. Sir, can there be a case where growth is... Oh, great question. So Lakshmi, she's from Trivandrum. She's asking, sir, can growth exceed your KE? So if you remember, Lakshmi, in CA Inter, this is the assumption of the Gordon growth model, that the cost of equity will always be greater than G. Nahi to what will happen? This will comes to be negative and this value will comes to infinity. So that was the first assumption under the dividend growth model that we had started in CA Inter, beta, that it has to be less than that. So cost of equity has always to be greater than your growth. Otherwise, फिर formula will become a problem. ठीक है? Okay. Okay. So Kunal has a counter question, but sir, if is also income from that stock, it is also an income from that stock. I am Kunal not getting a complete question, but at least I can sense something. You are saying, ki, sir, we are also getting the income from the stock. I mean, what I'm thinking is you are saying that I'm getting the return from that stock. Is it that's what I'm saying? If I'm presuming. So I'm saying again, holding a stock it has a two motives. One is the capital appreciation, so that will be there. That is for sure. Dividend is second point. So dividend is something that we calculate first, and then gradually we can see. Because see, capital appreciation we cannot predict. We are not God. We cannot predict. But yes, at least dividend we can predict. How? The way just like the way I showed you for the private bank. Why the private banks are more in demand than a PSU bank? Look at the price to multiple, or let's say see the net worth of the PSU bank. Absolutely, what word should I use in a professional term? I mean, absolutely a very penny thing. Look at any stock and look at the private companies. Why? Because the dividend has been phenomenal. So that's the reason everybody cheers to be part of those things. Okay. I hope you are getting my point, guys. Okay. Are we clear? So this was the first part, which is related to dividend. Almost we have spent about 1 hour on this. Now let's move further to the next topic, which is, I mean, we are still at fundamental analysis. We are doing the point number 2, which is the other than the dividend. Okay. So let's see what is there in our kitty today. Okay, so this I've showed you already that how do we calculate the P ratio. Okay, so you can look at any of the companies' financial statements, annual accounts, which are available on an yearly basis. So for all the companies now we have the 2020 accounts. So please go to the consolidated revenue statement, I mean profit and loss account, and bilkul last mein, in the last you can see all those figures. Okay, so you can calculate this P ratio. Yes, I understand this P ratio, everything is now available on a lot of websites, sort of apps and all that. But what you're studying, you should be knowing that how do we calculate that? It's not that we are depending on the technology and something is being shown, not properly. So we are believing on that. We should have our own calculation. This is what I just want to say that. Okay. Okay, so Lakshmi is saying that if just in case this growth becomes additional, then better you don't use this model of the growth one, then you use a normal CAPM model, okay, for this purpose. Then this formula will not be hold valid to calculate the intrinsic value, then you use this P multiples. So she's saying just in case in real life, if it happens that it is greater than, growth is greater than cost of equity, then this formula will not be applicable, then you use this P multiple to compare the value of this thing. So let's say P multiple of this company is 25 and for the industry it is 20. Okay. So again your stock is little higher, it is overvalued. And if it is 15, so it is undervalued. So you will not use this thing. I hope Lakshmi that's fine, beta. Okay, so now we are coming to the next part, which is called as your fundamental analysis, Kahi 1.2, which is called as the economic analysis. This topic, if when I used to teach it earlier, student used to get a lot of sleepiness. It says, sir, I mean, what's all this? So I put in a lot of practical things in today's class so that it doesn't bore you, it doesn't bothers you. Okay. So what is the second point is, let's discuss that. So for the first class, I mean, of this chapter, we are still at fundamental analysis. So we've already completed how do we undervalues or overvalues the stock estimation. Okay, we compare it with a
It's
price,
8 o'clock.
which is based on the dividends. Now the completely different. Okay, so now the dividend part will be cancelled out. Now we are doing something very fresh. Please do not try to inculcate any of the dividend concept here. Okay, because dividend criteria is one. There are other factors as well which tempts us to enter into the company. So what are the factors are that we are trying to study? Okay, so the second point is from the fundamental analysis, we do the economic analysis. Okay. Little boring for those guys who have not studied economics, and very interesting for those guys who have done economic honors, or let's say who have a very strong economic background. Okay. So what are it talks about? We have in economics. Okay, let me go give you a full word access. Sorry. Okay. So in economics, we have two factors. One is macro and one is micro. Okay. Don't worry, I'm not teaching you economics. I know you know better than me. So I'm not teaching you anything related to that. Okay. So in the sense, we always talk about the macro factors, okay, which is the historical performance. Okay. Historical performance of the economy. Okay. So in the past, in the present, and what is the expectations going forward, that we try to assess it while analyzing the economy. Today we are at a COVID situation, we all know, unfortunately. So there are some sectors which has done tremendously well, like the consumption sector, the digital services. You and me are also connected with it because of digital this thing. Otherwise, imagine if we are teaching to you face to face, everybody of us would have been using a mask. Okay, and if somebody sneezes or coughs, so we have a little uncomfortable situation over there. So we are using a digital technology which has done tremendously well, and there are some sector which could not have this let's say the opportunity to grow during this time. Okay, so here we are trying to analyze. What we are trying to analyze is we are trying to analyze the entire economy, the different sectors, the growth, the incomes, whatever is this thing, we see everything over here. Okay, so before I show you something which I have in this thing, so what are the factors that we see? Okay, we see the entire economy. Okay, how it is growing, every sector. Okay, different sectors. Okay, like digital services doing great, hotels doing not that so great. Okay, so this is now the COVID situation. Okay, COVID times. But earlier, hotels have done a great business because of two factors. One is coming into digital services, like you can check the price of the hotels online. If you remember, those Trivago and very funny ads used to come. So everything was come to the digital side. And after the introduction of certain companies like Oyo and all that, you try to cap the price. So they were doing great. Okay. So, but in today's time, they're not doing great. So what we do in a fundamental analysis is that whether we should invest in these companies which are currently not doing well, and you believe that it will grow back to the same business as they were during the pre-COVID times. So that will be your own fundamental analysis. Okay. So again, I'm telling you, all these analyses are all individual based. You cannot really have any conflict. I might say that hotel might don't do well. So you don't need to agree with me. You don't need to agree with me. You can, differ. You would say, no, I believe that the hotels will come back to the same pre-COVID levels, and I'm investing in this stock. I'm finding these stocks as completely undervalued. So I can buy these stocks. I mean, this is how the analysis has happened. All depends upon individual to individual. You cannot just enforce your right. Okay. So this is, you have to think, because what happens is, till the time we have not studied this chapter, till the time we are not in CA final, we believe as to what other people say. Let's say the stock analyst, the newspaper, the people who come in the television. You buy this, you buy that, you sell this, you sell that. Why? Because we are not in a situation to analyze the things ourselves. After we have completed this chapter, we will be in a ourselves situation that whether the step which I am taking is absolutely correct or not. Because now you are putting your investment decision in your own hands. You're not putting your investment decision in somebody other hands. I mean, looking at the newspaper, okay, he's saying that buy, let's say, Taj Hotel stock. So would you buy this stock? When do you think that the revenue will come to that level? Again, how much cost involved to sanitize the things and all those things can be a can be a headwind for them, or it will be a tailwind for them. That you need to see that. Okay, clear? So this is how individual perspectives are there. So how do we see all these factors in this is factors? Okay, number one is the growth rate of the income, growth rate of national income. Okay. Okay. During COVID times, as you know, that the national income had the lowest steep in the GDP, about 23-24%. But earlier times, India has one of the highest emerging economies in the world, one of the highest emerging. So today, every individual has a good style of living. Everybody has a car. Everybody has a shoe on his feet. Good watch to wear. Good laptops to use, because there is a growth in the national income, and there has been growth in the industrial sector as well. Industrial sector. Okay, so we have good production, copper, aluminium, all those things. As a result, we have good bridges, we have good infrastructure, as against our economy, which was 10 years, 20 years back. Okay. Third is the inflation. If the inflation is high, you tend to cut your expenditures on the other things. Just like, recently the onions were very expensive, coming at almost at a century price, almost 100 price. So did we stop eating onions? No, we did not. By the same price, we tried to cut our expenditure to some other areas. I mean, for those who are little underprivileged. Sorry to hear about that. So those people who are little under the poverty, they try to reduce their consumption on the onions and reduce their consumption somewhere else to match up their income levels. And the most important thing is, after inflation, you have the monsoon as well. So if the monsoon is good, then it's always good, I think. Okay. So this time the monsoon has been absolutely good. A lot of people who unfortunately lost their jobs went to their hometowns and started to do some kind of an agriculture activity. As a result, what happens is we had a good monsoon and good harvest, and we are able to get everything at the appropriate price. All greatness to those and all salute to those farmers and the people who had to go to their hometowns, villages, and carry out this activity. And the monsoon had been really good. Otherwise, we would have been more degraded form. Okay. Any doubts in this? I'll be showing you very interesting stuffs going forward. Let me take up your queries if there are any. Okay, only one query, which is related to P ratio. He says, sir, P ratio can be calculated for annually or quarterly. Can anybody think of the answer? I'm sure everybody can answer it, because I've given the conclusion during the class itself. The student asks is that, sir, the P ratio is to calculate it annually or quarterly. Beta, it is Raghuram, na? Haan. Raghuram, it is calculated seconds basis. Every second this value changes. Obviously, it's not a huge change in the value. Obviously, that 25 doesn't becomes 22 all of a sudden, but 24.9, 24.95, the value keeps changing. So this changes when there is a change in the market hours, means from 9 to 3:30 during the Monday to Friday wala slot. So it changes, and we have to calculate on a daily basis, on a regular basis. So for you, again, daily basis is not possible. You can calculate on a day basis, weekly basis, monthly basis, and then you can assess if something is higher than what is the P of an industry. You can always ignore it. If the stock is trading at below the P, then you can always buy this stock. Absolutely. Clear? Okay. So before we go further, let me ask you a very simple question this time, because your participation had been phenomenal during last time. Okay. So I am showing you a slide. Which sector you think will outperform in on the next year? But again, I'm telling you, this is all your own discretion. Don't take up my words. Okay, don't take up my words. It's all up to your uh, thought process. Which sectors do you think will outperform in the next? On is by mistake. Okay, so in the next must be one. Okay, so my articles must have could have done that. Okay, that's okay. Article assistants have a lot of pressure in their mind, so that's okay. Okay, in the next 1 year, so you can see the hospitals, healthcare, pharma, digital services, internet, oblique internet, hotels, or the aviation sectors. I must give you the disclaimer. All these fake images that you can see, we are using on a professional platform. These are all source of the Google. So all the copyrights remain with them. We are just, acknowledging as to about their figures, right? So can we have an answer, please? Okay, so Kunal believes that the digital services will be doing great in the next 1 year. Absolutely. I completely agree. I completely agree with him. Any more, guys? It's a simple question. I mean, not even a CA final question. I mean, CA final level question. Right? So can we have the answers quickly, guys? Quickly. Okay, the first two sectors is being said. Okay, that's great. So there's one student from Reba. I mean, this student is saying that, sir, first two sectors. Let's be very optimistic, and we should be optimistic since we are CA students. So let's hope everything goes fine. Every patient who is there in the unfortunately this pandemic gets treated well. I mean, they get absolutely fine. So do you think we'll require that much hospitals at a larger levels? I mean, if everybody gets fine, I mean, everybody's free from corona, then I don't think that we need hospitals to that level as we are at today. So we are asking for the next 1 year. Okay. So Raghuram is saying, sir, obviously hospitals are there. I mean, do you think, let's say there is a capping on the medicines by the government, so pharma company can have a problem. Now, as you know that US FDA, the United States FDA is the one who approves the medicines. So if there is a change in the government as elections are going on, so you might find some other headwinds or tailwinds for the pharma companies. So again, uncertainable. Absolutely. Digital services, I agree, completely agree, because everybody is now teaching online. I mean, everybody has become a teacher. What we can see that. Aviation, as of now, it's too demanding, but the date of international flight is also extended again and again. Obviously, Aman, we cannot allow Chinese to come here and put their spread again. At the end of the day, it's a Chinese virus. That's not what I am saying. That's what the Donald Trump says. It's a Chinese virus. So anybody could come and bring the virus. So we can't let our country be exposed to such. So that is the reason that international flights are down. Yeah, domestic, they are doing pretty well. I mean, definitely. They have able to sustain themselves. I agree. Okay, so let's not extend more time on this. What you have written? Aviation, hotel, and pharma higher to lower sequence. Okay, great. Chalo, that's great. Let's move it forward. Okay, the concept consisting of the techniques which are used for the economic analysis. Okay, so this is pretty simple. I'll show you everything on the slide now. Just two, three more slides. So we can have, how do we?
It's 8:15.
How do we do the economic analysis of this economy? First, we use the anticipatory surveys, which help the investor to form the opinion about the future growth of the economy. So there are a lot of associations. If you are based out of Delhi, New Delhi, the capital of our country, so you must have seen FICCI as one of the places in Delhi near Connaught Place, and there are other so many association chambers who keep doing these surveys where a lot of economists has been employed who look at the different areas of the economy, different sectors of the economy. What are sectors? What are areas? We'll discuss it in few slides. So these are the one who keep forming a opinion about the sectors which will outperform and which will underperform. Just like the way you have just told that aviation will not be doing well because of there is no international demand. So now they can put this opinion to the government that see, you are closing the international flights, you're not allowing international travel. Why don't you give them some subsidies? Why don't you give some taxation benefits? Why don't you give us some relief? So this is, how they take the views. The finance minister, the government of India, the president, they take their views from these certain certified agencies. Again, they will not take up on our own opinions. Okay, but they will have a kind of a anticipatory surveys. Second is very simple. We have a barometer or indicator approach, which is called as the indicators, having three types. One is a leading, lagging, and a coincidental indicators. Okay, so just they tell us that how the economic activities are going on, again at the high and low points of the economic activity. And there are some coincidental indicators. Sometimes something reached to the peak levels and the trough level. What is the trough level? The bottoming out. What is the peak level? The highest. Any example? Let's say there was a food chain industry called as Swiggy. There was a time it reached at a peak. I mean, imagine everybody was ordering from Swiggy, and the time came that everybody stopped ordering because the lockdown was there. Complete sector lockdown was there. So they see what is the roughly coincidental indicator. And lagging is that even if the economy has restarted, there are areas like cinema halls, multiplex theaters, hotels, restaurants. Today also we tend to get thoughtful that whether we should go there or not, whether we should watch a movie. Yes, we do like watching a movie on a big theater, big screen, eating in the restaurants. But are we really accepting that? That's a lagging indicator. So this is something which I have told you in a simple example. But for the government, how do we see that? Let me show you practically. So you can see that the barometer on the indicator approach, I've taken it from one of the economic websites. So it has all these things. Okay, very simply, I am telling you again, not related to exam. It's just that, if I'll say something, you say, okay. You should not be knowing what are indicators. So there is a GDP growth, okay, which is calculated on a quarterly basis. Okay, these numbers come every quarter. So there's a range as to what range we are. So we had a range of 5.8 as maximum GDP growth rate. And we had the lowest growth rate in this quarter, last quarter that we had gone, 25.2. Unfortunately for our economy. So these are the indicators, beta. We are defining a range. Okay, that's what we are. Just like during lockdown, you wanted to focus on the fitness. Okay, so you make a range for yourself. So let's say you said, I will be running for, let's say, 5 kilometers. Someday you run for 3 kilometers. Someday you don't even run. On a Sunday, you are sleeping like me. Sorry, Sunday I'm teaching. So let's say you are sleeping. Okay, so the range becomes 0 to 5 kilometers. So similarly, there's a range for everything. That is an economic indicator. So these are all that we discuss are economic indicators. Again, I'm telling you, if you are not an economic student, so must be feeling very bored, I'm sure. But if you have been economic student, then you know better than me that there are certain other things as well, like inflation rate, interest rate, cash reserve ratio. All these things are there. The ranges are given, the frequency are given, that how they are calculated, and as to what range we are into. And whatever negatives that you see over all here, which are in the red, this is red. Okay, this is red. This is red. So government try to pitch in these areas. Where they are fine, they are into the lagging side. For the leading, definitely they want the improvisation. You can see this manufacturing PMI. It is going little better. I mean, worst again. I mean, previously we had 56.8. The higher is better. And we are 58.9. The lowest we had 27.4. It is calculated on a monthly basis. That happened, I think, in April when there was a complete lockdown in the economy in our country. So I think we are at 27.4. So we have now reached at a stage of 56.8, followed by 58.9. So we are doing great well. Sir, why are you teaching all this? Just tell us very simply. Just tell us very simply, sir, why are you teaching all this? Simple सी चीज है. The thing is that you invest in economy only when it is going good. If the economy is not going good, it is not doing good, it is not going good, you will not invest in that. Don't imagine yourself as an Indian. I mean, we all are Indian and we are proud of Indian. Don't imagine you are Indian for the time being. If you are sitting somewhere in the US and you look India from this perspective, would you like to invest in the country or not? That is the first thing that we see as a barometer or the indicator approach. If you believe that yes, this figure of 25.2 is a temporary figure and it can come back to not even 5.8, let's say, but at least 2%, 3% growth in the next quarter, then you find the stocks as completely undervalued. And then you buy them, forecasting the 2021-22 picture. This is what happened in the stock market. Okay, again, not speculating you to invest in there, but if you manage to see that market, it touched to a great deepest nosedive level at 7,500 somewhere. Today it is back as 12,000 because it's not people are anticipating a growth in the current quarter. They're trying to anticipate the growth in the next few quarters to come, which will come in 2021, 22 maybe. So this is what we see. When we see the stock completely undervalued and we see that the economy has the potential, we look at these barometer indicators and we judge whether we should invest in the company or not invest. This is the main criteria. Otherwise, I have no reason to bore you early in the morning. Trust me. Okay. Any question, guys? Okay. Yes, agree with you, Aman. Okay. So demand supply of the goods. Absolutely. Okay. Okay. So I hope this is okay. I've given you the link where you can download all these things for your understanding. If you are interested in the economics of any country, you will find it over here. Okay. Let's move on to the next slide. So now we've done the first part of the factors which affects the economic analysis. So what is the other things that we need to see? Third point is called as the economic model building approach. Okay, how do we build this approach? In this approach, it's very simple, a precise and a clear relationship between dependent and independent is determined. Okay, so let's say what is dependent? We all studied in our school level. What are dependent? Let's say the price of petrol and diesel. They are obviously related with your price of the vehicle. If the prices of the diesel goes up, we will stop using our vehicles for some time and prefer the public transport. I mean, assuming there is no COVID. I hope, let's hope we could presume that. So if the price of the petrol diesel goes up, people will either shift to CNG or they will use the public transport in that particular case. But just in case, if the price go down, then we get more purchase of the vehicle because people will prefer their own personal mobility. And there are some indirect, let's say the price of the sugar and the growth of the economy. So whatever the price of the sugar is, the economy growth will take their own pace. It has nothing to do with the price of the sugar or price of the diesel petrol. So you just develop the models accordingly and see what is the precise relationship between your dependent and independent variables, which is there. So this is one of the part of the models. So you see only two things. It's all about your dependent and the independent variables. Now comes the third point, which is called as the industry analysis. Okay, so very interesting, very, very easy again. Okay, so industry analysis, what we are supposed to do is we are doing the assessment to be carried out. Okay, for all the conditions relating to demand and supply of a particular product. Okay, demand supply could be for anything. It could be for your clothes. It could be for your cars. It could be for your mobile phone. It could be for your watches or any other thing. So you see different thing as to how the demand is gonna be. Okay. So the first one in the fundamental analysis, again, the chapter is security analysis. We are taking two concepts. One is a fundamental analysis, and second is a technical analysis. For the fundamental analysis, we are doing the third point. The first point was to analyze the security based on the dividends in the future and discounting them to the present value over here, depending on your period of holding. If you are, say, let's say, holding for 5 years, you will discount it for 5 years. If you're holding for 1 year, you will discount it for 1 year only. Second thing is that once that analysis is done, second thing that you do in your life is you do an economic analysis as to how the economy is doing well. Is it doing good? Is it doing bad? In India, it's doing absolutely poor. Unfortunately, in the last quarter, down about 25.2%. But there has been indicators that we will be performing much better as per the positive statement by the Government of India. Okay, very positive and optimistic statements they have submitted us, which presumes us that we will be doing pretty well. So that is called as your economic analysis. We see at the economy as a whole, different areas of manufacturing, inflation, interest rates, all those things. So all these interest rates, everything determines to a great level. Okay, I will be taking up your chapter little later, quite later, which is called as your interest rate risk management. In this, I will tell you the impact of the interest rates on any economy. So there you will understand much greater level. The third analysis that you're supposed to do is called as your industry analysis. So in industry analysis, you just see only few things. Simply demand of products. During lockdown, I was very astonished to read that certainly the demand for two things grew up. One was large TVs and mobiles. Others were also there, obviously, but not that great extent. Now, since we are at almost Diwali stage, we are looking at a lot of consumer demands. Okay, consumer related. Let's say buying a refrigerator, new refrigerator, buying a washing machine. Obviously, air conditions now we don't need. It's almost now the winters are approaching almost, right? So all these things that we see during this time. So we see what is the demand of these products, what is the cost structure, and the economic and the government constraints on them. Okay? So how do we see all those things is that we need to see the very important thing called as the product life cycle. I'm sure you must have studied this earlier or forgotten. Okay? Or you have not seen that. So don't worry. I'm there to tell you that how it used to look like. Just give me some time because it talks about the profitability, not the sales. Okay? Again, I'm telling you, product life cycle exhibits a high profitability during certain stage and then you starts to decline unless you don't come into the market with a better approach. Okay? Let me show you the slide. So first part is the product life cycle. So this is how it looked like. There was an introduction stage.
It's 8:30.
Then there's a growth stage. There's a maturity and there is a decline. You can see I have made a blue color called as the product extension. This thing means introduction. You can see on the left hand side. I'm sure when this phone, I'm presuming when this phone was introduced in the market, you must have been very, very young. You might not have used this phone, I'm sure. But when I was almost, 5 years or back, I mean, maybe 5 years, this phone was a revolution. BlackBerry was a revolution. The kind of looks it has was just mesmerizing. Emails, everything was done from here. Everything was done here. So introduction had been excellent, growth had been phenomenal. But when it reached to the maturity, you can see this thing, this red color, this used to give us all the emails, messages, all those things. But today we have a feature from Google Baba. We have a Gmail on our phone. We have Google on our phones. We have any email accessibility over our phones. You can add email, any email, even if it does not belong to the domain of Gmail, like your office is using their own domain. You can just synchronize it with your phone, and you'll get the emails at the very promptly as against that thing. So as a result, this product had a good life cycle, having a good introduction, then growth in the maturity. So if you don't reach to this stage, product extension, you will be out in the market. You'll be completely out from the market. Do you now see anybody using such kind of a phone? You would say, sir, this kind of phone? You used to have a keypad like this? Yes, we used to have a keypad, and I'm telling you honestly, used to enjoy it a lot. We could type below, when I was in college, we used to type it from below the desk. Teacher also doesn't able to know. And the typing used to be very, very, very smooth. But today we have to do like this. That's an issue. So these days, phones are completely, just there's no angle, nothing. What do you call this? No borders and everything. We used to have all these borders, such a small screen size. You can see there's a 3G also over there. So the reason it went out of the market is because there was no product extension. They failed to bring the complete smartphone edition, the complete full screen, visibility, all those things. As a result, it declined. But for any company, the product extension means you have to extend those things and we remain in the market, just like Maruti has done. They came up with Maruti 800. Now they're not out from the market. So they have everything in their segment, starting from the basic WagonR to the highest of the best of the Maruti cars, which has all the features. So the more money you will pump in to buy the Maruti car, the more features that you will get. So you have different models, everything. You take the highest model, you take one more model lower, whatever the things is there. So this is how we are trying to do this during the product life cycle. That whether there has been improvisation in the products or it has not been there. I hope the example you're looking at might be sounding it funny, but that's the reality. Second is basically the demand supply gap. Excess supply reduces the profitability because of the decline in the price realization and vice versa. So if you see the figure on the right hand side, what is this? It's a power plant. Before lockdown, there was an immense power utilization, power consumption. Where do we consume those powers? We consume this electricity, obviously, besides in our residential places, we are using them in malls, airports, and most importantly in the mills. Mills means where all these sugar, wheat, everything is being prepared. So there the machinery runs almost about 24 hours, again depending on the demand and supply. So I'm not saying that mills got closed, but to a certain level, a lot of companies suffered a huge losses because of the mismatch in the demand and supply. When we go to the mall, we see a lot of lightning over there. Why? The consumption has been phenomenal. When we go to the hotels, when we go to the, multiplexes, but they were all shut down. We were in our homes. Yes, the production for wheat, everything was going on, but again at a smaller scale, at a smaller level. So the company faced the huge losses because of the demand supply gap. That's the second point. Well, the third point is barriers to the entry. Again, very, very interesting. Any industry with a high profitability will have the fresh investments. So anybody, can anybody enter into the market where the capital expenditure is heavy? Can you and me own a power plant? Can you and me open up a mobile phone company? I mean, on an individual basis. Definitely, the barriers to entry is there. So imagine this thing: a company who is into, let's say, manufacturing bikes. So there are a lot of players in the market, but this is not an easy job. You need to carry out a lot of research and development activity to make sure your product is phenomenal. And post selling also, you need to have equipped with all the technology so that you remain best in the market. I'm sure you these days you would be looking at some ads that you don't need to come to the service station. We will pick up your car, we will sanitize it, we will service it, we'll give you back at home. So all these things matters a lot. So everybody cannot enter into this industry where there are barriers to entry, like where the capital expenditure is very, very heavy. Okay, so these are the three things which is required for the industry analysis. Again, looking at that from a investor perspective, if the product life cycle of the company is absolutely great, it's at maturity, and again they are doing the product extension, then they are well great in the market. Imagine Cadbury. Just imagine Cadbury. I still remember the Dairy Milk chocolate I've been eating since childhood, my childhood. 5 rupees Dairy Milk, 10 rupees, 20 rupees. Entering into a chocolate market is very, very easy. Just open up a YouTube, especially our female students. Making chocolate is as damn simple as anything else. So why they are still in the market? They have done the product extension. They have bought silk, they have bought roasted almonds and lot other variants. And that would a very expensive price, very expensive. 100 rupees chocolate, 200 rupees chocolate. Do we still buy it? Yes, sometimes. Will we buy it in Diwali? Absolutely, we will. Why? Because the company has given you a lot of options to just go and explore a lot of things. You want to buy a 5 rupees dairy milk, you will get a 5 rupees dairy milk. You want to buy a 200 rupees dairy milk, you will get a 200. This is what called as the variety. Okay, if the company has such variety, it has a great product life cycle, you will go for it. You will invest in the company like Dairy Milk. But will you invest in a company like BlackBerry? The figure you can see now, nobody can use this mobile phone anywhere. Look at the screen. If I still remember, it was even less than 3 inches. So imagine these days the phones are 6 inches, 7 inches. Can you use these screens? Not at all. Videos will not be that clear. No 1080, all these whatever you resolutions you guys knows better than me. You will not have all those things. So you'll not invest in companies like BlackBerry, but yes, definitely companies in like Dairy Milk and all those things. The first thing. Second thing is where there is a demand supply mismatch. When there's a lot of demand supply gap, and you think that the power company are facing a lot of losses, so for the timing you will not invest in these companies. But if you find that the demand will be coming back to the pre-COVID levels, and you find these shares to be undervalued, then you can go for it. There are a lot of companies which are listed as far as the power companies are concerned. Third is your barriers to entry. So any a sector which has a lot of capex which is required, again like a power sector, you have a cement sector, you have automobiles, again where the entry and exit is not that easy. So you can always invest on those companies because there the competitors will be very less. Yes, I know that the figure that you can see relates to motorcycle. They have a lot of competition. Again, in the cars also you have a lot of competition, but that's not a problem. You can put all the companies together and you find out the best company out of them, and you can always do the analysis. That's not a problem. This is what people have been doing. I think since so many time, since so many years, that picking the best company from the best segment and investing in those companies. That is called as the peer comparison. Okay, peer comparison means you're trying to compare the companies who are into the same profession or the same competitive business. So you choose the best and you invest in that particular best company. Okay, guys, any doubts? Please tell me. Okay, so let's now move. Okay, so no questions as such. Let's move it further. Okay. Okay, so no further questions related to the concept. So let's move further. Next comes from we are still continuing with our industry analysis also, and it will go to about 10 to 12 points. Okay, 10 to 12 points will be going up, and we'll be covering up all of them in today's sessions. Okay, government sector, the government attitude. Okay, so the attitude of the government towards the industry of the industry is crucial determined for its perspectives. Okay, so as you know that any under-related sector, sorry, not underrated, but a lagging sector, government can always give some subsidies, some kind of a relief measures to them. This is what they see, and we have to see if our government is giving a good relief sector to the any specific sector, then it's always a good area to invest. Okay, so let's take an example that aviations are not doing great. Few students have also quoted it. Okay, so aviation is not doing, and our finance minister, okay, comes with a relief measure that they are not supposed to pay any tax in the next 1 year. Obviously, they will not pay tax because they are into losses. Okay, so let's take an example that they come with a relief measure because you know taxation better than me. So let's say the carry forward losses is, let's say, 8 years. So let's say she can say you can carry forward your losses for, let's say, another 15 years. So that's a great relief measure. So you can always invest those companies where you find that the news are positive for that particular company, and you can always and always, what you can do is you can always and always identify those under valued stock and buy them. Okay. E point, state of competition in the industry. So you have to see that what is the competition which is there, and what are they, how they're segregated, how they're differentiated, how are they placed. Okay, so you can see over here the massive state of competition in the industry. You can see few of the mobile phones, again taken from Google. So when we talk about today, there are so many options which are available. Vivo, Oppo, iPhone, this never settled. What is this company? I don't know. OnePlus, sorry. Okay. And Motorola, a lot of companies are there. So we look at this thing from a firm's perspective, that the companies which have the leadership capacity and the nature of competition amongst them in the foreign and the domestic markets. So who are the one who have the leadership capability? You must be aware, recently Apple company has crossed a valuation of $2 trillion. Can you imagine $2 trillion around the world? The phones are available. iPhone you will find in everybody's hand. It's a matter of pride. It's a matter of confidence for any person. And for the company, again, they are the best. They have been doing the best to the best in the business. They are the only one who came up with the 5G technology. So they make one model every year in September, October, and others starts following, whether it is Samsung, whether it's XYZ, so many names are there. So again, it says that when you want to invest in a company which is related to the state of competition, you see who is the best. You want to invest in Samsung, or you want to invest in the Apple company, sorry. So Apple have come up with a lot other features as well. They have their laptops, they have their watches, they have a lot of segments. Samsung was also there in the laptops segment, but they failed to achieve themselves. They came in the watches segment, they failed to do that. They are into consumer and everything. Samsung phones, Samsung TVs, Samsung refrigerators,
It's 8:45.
Samsung air conditioner, but failed to make a mark because others were there. What they are best is only in the mobile phones. But again, choosing them on the basis of mobile phone will not be a good criteria. Why? Because loss from other businesses will impact the profitability of the mobile phones. You're getting my point? If they're having losses from the other sectors, and even if the mobile segment is making a good profit, you just cannot choose that. You need to identify those companies which are best in the leadership, best in the business, and they are best in the what do you call in the profitability, because that's the bottom line for any person that is there. Okay, so you can see whatever competitions that we have, okay, in the market. But still, today also, the only company to touch this 2 trillion mark is only the Apple company, which is listed on the I think New York Stock Exchange, if I'm right, right. So this is called as your state of competition. We are continuing at fundamental analysis. So fifth point is sixth point is cost and condition profitability. The price of the shares again depends on its return, which in turn depend on the profitability of the company. So if you give me profit, I will take your company to the next good market cap. So as I'm telling you, Apple phone, Apple watches, Apple MacBooks, Apple tablets have all been doing well. As a result, that is reflected in their share price. Okay, if you see the Apple stock price soaring high, all-time highs. And imagine, how did they enter into the market? They entered with the iPod, carrying numerous phones on a single piece of a device, small piece of a device. You are carrying so many of the, what do you call, songs, MP3 songs over there. And how did they improvise? Because they knew that iPod market can be crushed by anyone. That facility is available on the mobile phone, that you can listen to the songs. But again, your phone has a limited capacity. In those days, the phone used to have a limited capacity of 2 GB or 3 GB, if I remember correctly. Now the phone's capacity is phenomenally large, 256, 128 GB. So they knew that they will be crushed in the market. So they introduced their mobile phones, they introduced their watches, they introduced a lot of other segments as well, in which everything is doing great. So again, the cost, conditions, and the profitability is the one which we are there. Every year they launch their phone, and every year, every company, every individual, every retail person buys that phone. So you can see the formula, the picture, that is the iPhone 12 Pro. Made a new, debut in the market just few months back, and doing great. Has been into a great demand. Everybody needs to have that. Again, yeah, it has a 5G technology which is yet to come in India, but still the demand has been phenomenal. Okay, so they have a competitive advantage over others. So they are the one who are putting the prices as 1 lakh, 1,50,000. So in that case, you are in a situation to even buy that thing, even if it is quite expensive. You're getting mobile phone at 1 lakh rupees. Can you imagine a 1 lakh rupees mobile phone? You can buy a good sports bike in that, but still people are buying that. It's all because of they have the competitive advantage. So I hope this is clear. Again, these conditions will be easier to remember and learn and quote in the examination if you try to put all these pictures in your mind when you are studying for this chapter, right? Any questions, guys? Okay, no such questions as of now. Okay, no such questions. Then comes the technique where we can use this industry analysis. Is the two things are there. One is regression analysis and one is input output. This thing, regression analysis, I'm sure that is part of correlation and regression. Okay, I'm sure you have heard this name. I'm sure you have worked in this name, and I'm sure you know what is it, but you don't remember right now. Don't worry, we will have time today. We will tell you how we use this technique of regression and correlation in little while. Okay, this, what is regression, correlation? I'll show it in the Excel sheet. Again, not related to the exam, but you should be knowing that what is correlation, regression mean, because this concept will again come a little higher, few slides ahead. I'll do that. Second technique is the input output analysis. Okay, so how do you see this input output analysis? You see the economy and the steps in the production process, detecting the patterns and trends, indicating the growth in industries. So what is again patterns and trends? This again I have to teach you in the technical analysis chapter. So these two concepts in the techniques used in the industry analysis, the one is regression, correlation. I'll cover up with you today itself, 9:30, 9:40, in between that. And the second point, which is the in and output analysis, which is done with the help of patterns and trends, which I will cover up with you in the next class, which is on Thursday, when we are studying the technical analysis chapter. So you will understand what is our pattern, what is our trends. It's a very big chapter, so we'll try to complete that. I hope that's okay, guys. Okay, chalo. So the fourth analysis that comes out to be, that's called as your company analysis. Okay. So this is also one of the technique to analyze the fundamental analysis of a particular security that you intend to say put in, means tend to invest. So the fourth point is the doing the company analysis. Here also we will see the techniques using the correlation and regression and some scatter diagram and decision tree. So that I will cover up today itself. Don't worry, you'll find that very interesting to do that in your real life as well. Okay. So company analysis is what something that it's all about doing the analysis of a company, requiring the careful examination of the two fundamentals. What are those? Both quantitative and qualitative. Sir, quantitative we know, some related to your finance, obviously financial analysis, balance sheet, dekho, P&L, cash flow statement, all those things I know. What is qualitative? Means what is good in the company besides the number, like the management. When we hear good names, so we get to have a trust in us that yes, we can buy that. We trust Mr. Ratan Tata, so we buy Tata products. We trust honey like Dabur honey, so we buy the Dabur honey. We trust Bajaj products, so we buy the Bajaj consumer products because that's our very old in the market. So similarly, one is a quantitative that shows us that you have the strength, and secondly, qualitative, that whether your company has the products which are easily acceptable in the market. Are we ready to buy, any product which is of a local quality? No, we always for a good company where we know that the promoter has been absolutely good and we can trust them. Okay, so let me share the slide with you. Okay, thank you, Neil, for your kind words. Okay, so let me share the slide with you. Okay, so this is what basically the things are. How you can do the company analysis, the quantitative and the qualitative. Okay, so let's take up the net worth. Okay. So what we do, students, in the net worth, very simple. Okay, how do we calculate this? We add up the equity share capital, okay, preference share capital, okay, free reserves, means the one which is in the cash reserves. So companies act mein you are studying na, I mean revaluation reserve or any other thing is not a free reserve, like security premium, all these have the motives to be kept. Okay, so you add all these and you reduce two things less: intangible assets, okay, and your carry forward losses, if any. Okay, so if they are okay, if not, not a problem. Okay, so you know that if the net worth is strong, okay, the value that you get, okay, so you get the total net worth. You divide this by, this is a divide sign, okay? You divide this by number of equity shares outstanding. So you get the net worth, or you can say the, you get the net worth of this company, okay? So you have to analyze what is the company's net worth, because it can be negative. It can be negative, like our aviation companies, SpiceJet, Indigo, they're all having a big losses. So the net worth is somewhere in the negative side, right? Somewhere in the negative side. Then comes your, let me show you about this thing practically. I have a lot of material for you today, don't worry. So this, you can see, again, I've taken it from, for just illustration purposes. Okay, please, no speculations on any stocks or anything. We're just doing our academic studies. Okay, once we become chartered accountants, we will definitely guide you, or it could be a position, it becomes vice versa. You become more proactive in your understanding. You teach us that, sir, this is the area to invest upon. So even I would like to, see the time and the going forward. So you can see the net worth of Reliance Industries Limited. This is as per 31st March 2020, because I've taken it from the annual reports. Okay, so you can see the net worth of this company, 3,75,000. 3,75,000, but again in crores. Okay, so it says almost 4 lakh crore. So the net worth of Reliance Industry is almost 4 lakh crore. And it was around 3 lakh crore, then almost 3.5, then almost 4 lakh crore in recent time, which is 1920, as per annual accounts. Book value, you can see, students, how they have done it, 17, 18, and 19. This is the book value per share. When you've done all these things, when you divide it by the number of equity shares outstanding, which you know from the balance sheet, it's there on the equity side. So you divide that. And this is just an additional, which is debt equity ratio. It has nothing to do with this. But I just thought that I would share with you as to how the book value and net worth looks like. So net worth is in value form, and book value per share is in per share form. As we see that, if we see that number growing, it's always good for any investor. Okay, so this is just for your academic purposes, nothing to do with your this thing. Okay, great, guys. So this is first point, that you look at from the fundamental analysis perspective. You look at all such values. Okay, let me take you back. Then you have some sources of and uses of funds. Okay, so this is simple, not a problem, because we have been making our balance sheets, fund flow statement, all these. We have a chapter called as NPO, non-profit organization. So where we used to make sources and application of funds, if you remember. Also in our cash flow chapter, we used to make, rather than making a balance sheet, we used to make the sources and application of the fund, means use of the fund. You can always analyze the companies as to from where the income is coming and where this has been applied. What is the reserves the company has, whether they are strong enough to stand even if during those COVID times without even shutting down their business. So that can be a good point to bet on, right? Third point comes in the fundamental analysis. In the company analysis point is C point. We are studying the first topic, which is the fundamental analysis of this chapter, in where we have done 3 topics: dividend, industry analysis, and now economic. Second is economic analysis. Third is industry analysis. Now we are doing company analysis. Okay, extension of all this. So fourth C point we are studying is cross-sectional and time series analysis. Okay, so again, what you need to do is again compare the two firms.
It's 9 o'clock.
Which I told you, the peer comparison. Okay, you can have some benchmark figures with the industry and see how they are doing it. You can see what I have pasted in front of you is, again, I think this is for Reliance only, if I'm right, because my articles have prepared this. So I'm sure this is for Reliance. So you can see this is not, it doesn't have a benchmark with the industry. Okay, with the any peer comparison. They're their own comparison. So you can see there are a lot of cross-sectional figures. Everything has been put in across, like the earning per share, turnover per share, book value per share, debt equity ratio, EBIT by gross turnover, net profit margins. So let's say net profit margins, are they improving or not improving? So from 7.8, it has gone down, then again coming up, then phenomenal 10.9, 11.9, 10.7, came down, and 9.6. So we can always see the time series. This is called as time series. When we analyze certain situation, certain what do you call trends during the last few years. So you can see last 10 years, they are able to maintain a good net profit margin on average about 8 percentage, which is okay. Again, if they go for more cost improvisation, they can improve it further. Okay, so this is just an example how you can do that. If I put one more figure here, let's say for what is the industry benchmark, okay, over here. Let's remove this and we put the industry figures and we can compare that. That is called as your cross-sectional and time series analysis. I hope that's fine. Then comes the fourth point, okay, that is called as your size and ranking. So the size and ranking, very simple. Again, you can match those sizes, the net profits, the return on investment, sales figure, and can be compared with the data of the similar companies. Okay, so let me show you some of the data and growth financial analysis of that. Let me just show you a few of the data. Just 1 second. So again, students, beta, this is just for your academic purposes. It has nothing to do with this thing. So you can see we have compared 3 companies which are great in the market. So let's say Maruti, Mahindra, and Tata Motors. So the rationale behind this is analyzing is that we are looking at the 4-wheeler segment. Okay, so we have a 4-wheeler segment, then we have a 2-wheeler segment. Okay, then we have some tractors, then we have trucks. All those things we have made a comparison of this. Only for the academic purpose we do that, where we take the figures and put it on a comparable basis. Now you can say that, sir, Maruti ka 100% is not coming from only 4-wheelers. So they have other segments as well. So to make it on a comparison basis, is what we have done is, from the total revenue of 100%, 83% revenue comes from selling the four-wheeler like Wagon-R, all those cars that they have. And Mahindra are not only in 4-wheeler, they're also in the tractors business. But 31% business comes from your 4-wheeler. So we have taken 31% of their figures. For Tata Motors, 84% business is coming from their 4-wheeler segment. So we have compared that. So we have calculated all their revenues and we have calculated their net profit, and Maruti is coming out to be the highest. Can you imagine? 28% net profit ratio as against 2%, and Tata Motors is -7%. So all these things are seen in there. Then you can have a lot of other ratios as well. Let's say EBITDA, EBIT ratio, fixed asset turnover ratio, return on equity, many, whatever you want to do that. Similarly, you can compare the other companies as well, like a 2-wheeler or 3-wheeler segment. Okay, so Bajaj Auto, Hero Moto, Eicher Moto, and your TVS Moto. All these can have a comparison together. Bajaj Auto has 95% business from the 2-wheeler and 3-wheeler segment. 5% is because of their sale of spare parts and all that. So we did not take up that. Hero Motor did not specify anything. So we have taken 100% of this figure. Eicher Motors 88%, TVS is again 88%. So again, we have made a comparison. So you can see net profit ratio over here. Bajaj Auto and Eicher Motors has been doing phenomenal. You know, Eicher Motors, Bullet, Royal Enfield Bullet, every young, handsome, smart boy's dream, you know, that is your Eicher Motors. So that is doing phenomenally great. Bajaj, we all know, Pulsar, Bajaj Extreme, all these machines. TVS, we all know, TVS Apache, TVS Scooties, a lot of things are there. Hero Moto, we have, I don't really remember anything. I mean, we have a lot of bikes from there. I think Passion and a lot of other bikes that they make. So again, who is doing the best? Bajaj and Eicher Motors are being doing phenomenal as against the TVS motor. So again, this is not related to curriculum or anything. We're just trying to show you that how you can compare such companies for the purpose of having a better understanding for your concepts. Okay. So we can have size and ranking. Okay. So as I just shown you, students, the net profits, return on investments, you can calculate ROCE, you can calculate RO, return on capital employed, return on free equity, whatever the ratios are, and compare with the similar data of the other companies in the same industry group. Okay. So like two-wheelers, we have Hero, Moto, Bajaj, Eicher, and this thing. So similarly, we can see that. We see the growth rate in the sales, the net income, net capital employed, and the earning per share. Okay, I think earning per share I already showed you in the previous one, if I remember. Yeah, this is the earning per share, which has been good, although, but not very good. 62, then 70, 84, 96, amazing. Then coming to half. Okay, so this is what you can calculate. NW is return on net worth. ROCE is return on capital employed. So you as a CA fan student should be, you are expected to be aware of all such ratios for the purpose of comparison. Okay, I hope finding it practical and interesting. I hope so in this class. Otherwise, if I keep reading those theories without showing you anything, you would have been sleeping for sure. So to make keep you live with us with the class and completely wakened up, I had to show you all these things. Okay. So we have financial analysis, which I've already shown you. You can have a better understanding with the help of financial solvency and the liquidity, profitability, operating efficiencies, all those things, operating leverage. So you can add on more points on the downside of the sheets for this purpose. Okay, that's clear, I guess. Okay, so one more slide, and after that we'll break for 5-6 minutes as your normal water break. Okay. G point is, again, we are doing the company analysis. The G point is the competitive advantage. Okay. So competitive advantage is another business consideration is having a competitive advantage. Whether you would prefer, if I would say, assume all mobile phones comes at a price of 50,000. Everything flat. Apple, Samsung, same specification, everything. Apple, Samsung, ABC, XYZ, DEF, JKLF, whatever. Okay. Same specification, camera, storage, everything comes at same price, 50,000. Which one will you buy? I'm sure you might not answer it on that chat box, but 99% guys, you would say, I would prefer to buy either iPhone or either the Samsung. Why? Because of the competitive advantage. Like, you know that they are able to sustain themselves in the business since so long, and they're still going for more and more innovations. Okay. So somebody was telling me, I'm not very sure because these days people are wearing masks. So Apple iPhone 12 has the capability that even if you are wearing a mask, it will open up the screen. I mean, the lock will be opened from your eyes. I don't know if that's true or not. Somebody told me that it gets open from my eyes only, even if I'm wearing a mask. So that capability is there. I mean, otherwise, when we use a phone, we have that facility that it opens up when it scans our face. But it, I think, has a facility that even if you are wearing a mask, proper mask, covering your nose and mouth, you can open up that. So that is again talks about the innovation, the competitive advantage that we have on that brand. If everything becomes flat, simple, iPhone, Samsung, I'm sure most of you would be going for either Apple or Samsung. Again, 99%, 95%. Others you want to go for some other brands. Again, that's absolutely your choice. And the corporate governance, again, you are complying with all the aspects of clause 49. I think this is for your SEBI and Companies Act, which again I'm not very uh, frequent and very comfortable with. So all the governance policies, quality timelines, all these things. I think if you remember, I told you in my last class that there are certain companies which we will talk about in our later chapters when we'll study the concept of ADR and GDR in the International Financial Management chapter. So I'll show you that how these companies are listed across London and US, and the compliances are so strict that if you don't comply with it, you will be out of those stock markets. So you need to comply with such corporate governance on a absolutely regular time period. They don't give you any relaxation. In India, if you don't file your results in this quarter, you can take the permission and you can file the 2 quarters result in the next one. But under SEC, Security and Exchange Commission, the rules are very, very strict. You really can't follow that. So that is again, is if the company is making absolutely proper corporate governance, then it's always good to invest in that company. Just to give you a very simple example, there was one of the companies, if I remember, a very simple, I don't know, the name of the company was, I think, Manpasand Beverages. Again, not speculating you. I mean, again, not a good company. Why? Because the auditor resigned. I think the CFO also resigned. And they did not file their results on a timely basis. They filed their results for 2 quarters in a quarter for the last 2 quarters. So again, they did not comply it. So whenever such delays are there, you should always get very, very, keen and strict as to why they are not complying it. That should, create a benchmark or a, let's say, red flag in your mind that why are they not complying with this thing. If they are not doing it on a regular basis, we should not invest in companies. Unlike other companies like Infosys, TCS, Wipro, they come up with the results so early. At the end of the quarter, within 1 week or let's say 10, 12 days, their results are finalized and they are doing all the filing and everything on a very timely basis. So this is what all about the corporate governance is. We'll continue this topic and we'll continue with the regression correlation and with the few of the queries that came up in the last class. We will cover up that as well in our continuing session. Hope to see you after 5-7 minutes of break. And you have any doubts, please do not hesitate. You can post your queries over the chat box. Once we'll resume the session, we'll take up all your queries. Okay, I'll see you in 5 to 6 minutes. Bye. Take care. Let me just see. A lot of questions have come up. Okay. Yes, beta, I agree what you have said. Student from Mumbai, absolutely correct. I'm sorry, I'm not able to take that name correctly, but anyhow, yes, agreed. Okay, so shall we move ahead? Okay, we are continuing the session where we have studied about the company analysis, and we have seen a certain things which can give the competitive advantage to be in the market and can improvise you to be part of them as an investor. Now comes the next thing is, as we have studied, these are all the quantitative terms that we have studied. What is the qualitative terms? Okay, so let me share this slide. Do you recognize these two guys? I hope you recognize these two guys. Number one is Mr. Uday Kotak. He is the chairman of the Kotak Bank, and below is Mr. Mukesh Ambani. He is also chairman of the Reliance Industries. So basically, we look at the qualitative factors, that how the quality of the management is, how the trustable guys they can be when it comes to investing in their companies. So if they are doing good, we have a good faith on them, we invest in their companies. But when the quality of the management is not appropriate and we don't trust those guys, then we can always and always say no to our investments. Okay, so what do we see basically? What is their past growth rate? What is their dividend policy? How have they kept the relationship of the shareholders and with the company? How transparent they are into, basically, that we need to see. Clear, guys? Next comes is the fundamental analysis. Okay, just let me take one doubt. If the analysis of the company is not being done. Yes, so one student from Ahmedabad, I guess. Okay, so that's great. Let's move ahead. Okay, next come the analysis is in terms of regulation. Regulation plays an important role. Again, if you don't follow the regulation, you will not be a good person. Let's take an example. If you jump a red light, okay, if you are not caught, then you have not done anything else, nothing bad. But if you get caught and unfortunately you don't have the money and the challan amount comes to your at your home, so again that creates a sensitivity in the mind of your family members, that why did you jump the red light or why did you not wear the helmet. Similarly, it happens in the regulation as well. If a company did not file the regulations properly, and if it is not caught, then it's fine. And if it is caught and is not done that, then it's a wrong part on the company. And who is the one who tries to catch up these regulations? You as an investor, you as a fundamental analyst. Again, just like the police person or the camera see you while you are jumping a red light, it's like you as a fundamental analyst, that you need to see whether regulations has been complied properly or not. Key point is location and the labor management relations. Depending on the what kind of a manufacturing facilities you are getting, you have the appropriate, skilled labor, raw material, etc. Again, needs to be considered. If your production is such that you need to depend a lot into the outside India's production, like you need machinery from China, you need parts from Germany, you need products from Italy, Spain. So if you are dependent on other countries, and if the relation with the other countries does not favor us in the near future, then it can be a harm to the company. If the company is making 100% goods domestically, that made in Bharat concept, or Atmanirbhar Bharat, all those things are there. then you are in a very competitive position because you are not dependent on any person. That's what you need to see in that company. Pattern of existing shareholders. This is very important and we tend to overlook that. I'm sure 99% people overlook that. I'll show you today how you can see that. What is basically first shareholding pattern is, see, when you start a company, let me show you over here. So let's say you start up a new company and before listing, you are the, let's say, founder, co-founder, chairman, promoter, whatever you want to say. Okay? So this is the 100% of the company. Okay? Let's say 70% are held by you, 30% like mother or father, or let's say any relative. Okay? Just for the namesake purpose. When you go for this listing, means IPO, means in the primary market, then you have to sell this stake. You can't sell your stake right now. You start selling this stake. And whom do you sell? FII, foreign institutional investors. DII, domestic institutional investors like LIC, the biggest of them, or the mutual funds. It could be individuals as well, to big names. You've heard big chartered accountants who are into this line. I will not take their names, but they are also in that. So you can sell the stake to them. Fine? Done? Easy? So as you keep progressing, because this 30% you've sold, okay, let's take simple, clear this thing. 10% goes to him, 10% goes to him, 10% goes to him. Now a new investor comes into your business. He's interested to buy your business. So what happens is, you will have to sell your stake right now. Now, today, okay? So let's say you sell 2% stake in 2020. You sold another 5% stake in 2019. So your stake is coming down. From 70%, it became 68 and 63. And as you know, you need to have more than 51% to retain the control of your company. So if that stake is going down, then it's a negative impact. For you, who are you? You are an investor. Why? This is the person who started this company. Now, if that company is doing good and he started putting more people on the board, he's selling his stake, he's having a less control of the company. Then
It's 9:30.
It will not have that kind of a powers with him to improvise this company. So as a result, we have to see in the annual accounts that where you can find this thing. Okay. So giving stakes to these companies is good, because at the end of the day, they are not doing any value addition. They are just making money. Yes, absolutely. They're just making money. Being part with the growing company is what giving you a good rate of return. And that is why they're investing in your company. So the share held by any of your relative, mother, father, relative, brother, sister, you've been sold to these FII, DIs, and they are making good return of money. And when you're selling further stakes, then you are reducing your decision capacity, and you are letting other people to enter your company. So that's a negative point. How can you see that? Let me show you the screen. You can see the latest shareholding pattern of Reliance Industries, again taken from the annual accounts of 2020. So you can see these four names: Sri Chakra, all these things. These are all owned by Reliance. They are all home companies. Okay, owned by, what's her wife's name? Nita Ambani, I think. Tina Ambani. Nita Ambani. So these are all owned by Nita Ambani, Isha Ambani, Akash Ambani, all those things. Okay. Look at these company, LIC. Who is he? He is the DII. He had a stake of 6.81% in 19, and he has a stake of 5.87 now. Although 1% seems to be very, very small. Very small. But look at the numbers. From 43 crores, it has come down to 37 crores, which is a negative impact. Which is a negative impact. That we have to look in forward at why this is happening. Okay. Stake of Dev Rashi, I think. This is again the promoter's company. The promoter is selling a stake from 11.21% to 8.02%. So this is nothing but your promoter holding in the name of the family, friends, relatives, all those things. So it has consistently gone down. From this enterprise, it has gone up. So we need to see these reasons as well. These are all the shareholding patterns which are available on the annual accounts. And on a quarterly basis also, before the list are shared, companies share their shareholding patterns if there is any change. So when there is any change, people take it as either positively or negatively. So again, when the promoter is trying to exit the market, it is absolutely very negative for the company. I hope this is clear. Any doubts, guys? Okay, no, I think no queries as of now. I think so. Okay. So let's move in forward. Okay, is it so? So again, I told you the pattern of existing stock holdings is what needs to be relevant. Marketability, again, the liquidity is important. If the share is illiquid, then you will have a difficulty in selling it. Again, if you are a very liquid share, it becomes easy. I think in the last class, I gave you an example. Let's say you have 5 crores to buy a property. I don't know where are you located. Okay, let me give the example from Delhi because I belongs to Delhi. Okay, so let's say you buy a property somewhere in Greater Noida or even farther than that. So you will have a problem to sell that property in the near future because a lot of people have not migrated there. Okay, I mean, still people are migrating at a greater pace, but again, you will have a problem while you want to sell it again to a person at a profit. But let's say you buy a property somewhere near Connaught Place, okay, the central Delhi, or let's say any posh locality in the central of the Delhi. So you will have a good amount of a marketability of that property. Means you will find the buyers and sellers very easily. That is called as the marketability of the shares. If the shares are absolutely illiquid, then you should not invest in those shares. If the shares are marketable, means you are able to buy find the seller. If you have already bought those shares, then it's always a good point. So again, very simple, nothing technical in this. Now come to the last point, as I've already promised you that the techniques which are used in the the industry analysis, will be using those same techniques in the company analysis as well. So what is that? First, correlation, regression, trend analysis, and the decision tree. So I know that you must have forgotten the correlation. Let me take it forward as to how the correlation figure used to become. Should I? I'll show you. So rest assured, this is our last topic for the day. The chapter will be complete now. Don't worry. Okay. So techniques. I will also cover up the trend analysis as well here. With the help of those scatter diagram, I'll show you. Okay? On the Excel, don't worry. Let's put arbitrary figures just to have an understanding of the correlation regression. Again, you would say, sir, this we know, but I want to show you something practical. Okay, something practical. Spare about 2-3 minutes to have your patience. and then gradually we'll understand this. Okay, are we good to go? Okay, let me see any questions are there. Okay, so before we start, there's a doubt by a student from Mumbai. A student asked, sir, while analyzing the shareholder movement, absolute number are more important or shareholding? No, not absolute number, because beta absolute number will remain same. 100% will remain the same. We have to see that how this exchange has happened. If LIC has existed, sorry, not existed, LIC has exited, who has come into play? Is he a better person? Because LIC comes generally from the motive of making a profit. They don't have those board of members who wants to part of the company. They just want to make good money, so they enter into the company's shareholding pattern. So if they have exited, who has the one who has entered? Is it someone better than LIC, or is it someone good that he wants to be part of this thing? I think as a part of good, let's say, a management reputation, and that will be adding value to the company. That is what we need to see. Absolute value will always remain the same. 100 will remain the same. One person will go to someone else, and somebody once will come for one person, right? Okay, I hope that's clear, Neil. So X, Y. Now I'm doing something very basic thing. Then I'll tell you that how we can use this correlation regression in our real life. Okay, so let's take very arbitrary figure. Okay, let's say 10, 15, 20, 25, and 30. Okay, so luckily the total shall be 100. ऐसी figure लिया, ऐसी लिया, ठीक है? Let's take Y. Okay, let me take those figures which will be little correlated. Okay, let's say 23, 33, 43, 53, 63. Okay, can you see the trend, beta? Can you see the trend? If it's increasing, this is also increasing. So correlation can be positive, it can be negative, it can even be zero. But in rare case. Again saying, the pattern has been positive here. Correlation has been positive here. I'll show it to you, don't worry. I'll show it to you mathematically, statistically, with the Excel, don't worry. But we can see the pattern is positive. If X is increasing, Y is also increasing. Okay, so there's no non-uniformity. So how do we calculate the correlation? Let's see that. What is mean? In this case, 100 divided by 5, 20. 215 divided by 5 is 43. We do X minus X bar. Okay. Y minus Y bar. And the product of that. Clear, guys? ठीक है ना? Now we need to calculate these values. So how do we calculate that? How do we calculate that? X minus X bar, which is the mean. So these values will come out to be minus 10, minus 5, 0, 5, and 10. Simple, na? This we have already done in junior classes. Minus 20, minus 10, 0, 10, and 20. Don't think is, sir, kya kar rahe hain? I mean, I'm trying to show you our relationship. Don't worry. Okay? Okay? So product of them, 200, 50, 0, 50, and 200. Okay, beta? 500. Okay, fine. How do we calculate the correlation? I hope you remember the formula. I hope so. Okay. So the formula is, first we have to calculate the covariance. Okay. You have to calculate for correlation. Let me write it here. covariance divided by standard deviation of x, this value, and standard deviation of y. Okay, don't worry, I will not be doing all those calculation. We have our Excel with us. Okay, don't worry. So I'll share the Excel with you. Okay, so what is basically the covariance is the product of this means sum of xy divided by n. Okay, so what is the covariance? Product by n, which is 500 divided by 5 equals to 100. Clear, guys? This is our covariance. Can we do this rest of the thing in Excel? Any doubts still here? Okay, let me just quickly read this. We have these x values, we have this y values. What is the rationale to do all this calculation on the board? I'm trying to explain you the concept of correlation, regression, and trend analysis. Why I'm teaching you all this? Because this is used as a factor to determine the company analysis. So how to do it? First, when we have two values, we see whether they are into a positive territory, means having a positive correlation, or they are having a negative correlation, means they are into a negative category. So they are coming up to be a positive one. So their correlation must be positive, right? We calculate total, we calculate the mean. X minus x bar, y minus y bar, product को divide किया by n. So we got the covariance. Now to calculate correlation, we need this formula. We have this formula from CA Inter. Covariance divided by standard deviation of x and standard deviation of y. Okay, done. Covariance we have calculated. Standard deviation we can't calculate. So let's take the help of Excel. Obviously not Google, huh? We can't take that. Let's do that. So let me share this file, same to you. Okay, I had these things prepared already so that we can save our precious time. Okay, guys, same. Everything same. Yeah. Till here we have done the covariance. Now we need for correlation, we need two things. Number one is the standard deviation of x and standard deviation of y. So let's use that standard deviation of x equals to standard deviation. Okay, you can see this. What is P and what is S? P is for population, S is for sample. So we are doing for the complete population. Let's select this 1, 2, 3, 4, 5. Let's enter this. Clear? Not clear? See again, students. Do standard deviation of y equals to STD EV. Okay, again not relevant for exam, just relevant for your understanding, because I know that you must have forgotten the correlation. Okay, standard deviation of P from 1, 2, 3, 4, 5. Enter.
It's 9:45.
Correlation comes out to be 1. Why did it come 1? Look at the formula. Covariance 100 divided by standard deviation of x, which is 7.07, multiply by standard deviation of y, which is 14.14. Why did it come 1? Have I done something wrong? Have I played any trick? No. The only thing is you see the pattern. When it is increasing, this is also increasing. So correlation is coming to be 1. Let me manipulate these figures. Let me put it as not 33, less than that, let's say 15. See how the correlation changes. Less than 1. Let me put a negative figure here. Minus 30. Correlation has become negative all of a sudden. Why? Because there is no pattern. 10, 15, 20, 25. This is increasing. This is 23, then coming down. Let's say put 33. So it is at a going trend, 53, but then became negative. So correlation became negative. Just like our country, like any other country, we are doing phenomenally well in so many years. Then comes this negative figure, which is nothing but your COVID crisis, and our correlation become negative. Clear, guys? So this is how we can see the patterns in terms of anything for any company, for any perspective, right? So if you want to see the second part, which is called as your trend analysis, which is let's say your what do you call trend analysis, you can use your scatter diagram. How to use it? You can just select this and select the anything, whatever you want. I mean, let's say trend line. So trend line is going as negative. X is okay, that is going on a trend, and this is just like our GDP, it has gone down. Negative. If I put it as positive, let's say 66, so they are both in a positive trend. That is called as the trend analysis. Okay, so one of my students is saying, sir, thank you for teaching us this Excel. Please, this is not, firstly, thank you for your compliments, but this is not the Excel class. I just thought that I would show you all the things in the Excel. Rather than I could have shown it on the board, but at the end of the day, we have to start working in the Excels now. So this is how the trend analysis can be. If I take the round figure, like 66, 53, 43, then 23, then 13. Then look at the trend. Absolutely falling trend. So this is how we see between two dependent and two independent factors from here. Okay, guys, I hope that's clear. And we are left with about 10 minutes. So let me take up your queries because I think the chapter has ended. Let me just check first. I mean, not the complete chapter, but this thing is there. Okay, so great. My articles have also shared the this thing also, the working over here as well. So you can see the standard deviation of X and Y, and this is what the correlation was when everything was patternized. Okay, so this you can do it at your home because I'm presuming that wherever you are working, you will be working from home. So you can do it and at your easiest time, and I'll be more than happy to assist you. You face any problem, you can look this video a number of times so that you will get more understanding. I may be little fast in speaking sometimes or this thing, but at the end of the day, the concept is something which is required to be remembered for doing any analysis. Although obviously these Excels, everything is not part of our CA examination, but we should know as a CA student, as a CA finance student, how to calculate all such things. I hope that's fine, guys. Okay, so let me take up your queries and also show you that slide also, which we are supposed to cover up last time. Let me take up that. Yeah, risk management. Okay. Okay, so any doubts, guys, before we take up previous, we have 10 minutes exactly. So there was a doubt that I did a question from the last, in the last class of risk management pertaining to VAR, which is value at risk. So 3-4 students asked me that, sir, from where did you get this 2.33 value? So I said, beta, today I don't have the table. In next class, I will show you the table from where you can get those values. So if you remember, we are doing at 99% confidence level. I'll show you the question. I'll show you the table where you have to see the values. But for today's class, if there is any queries. Okay, so examples of Excel calculation made are 3. Okay, worth it. Okay, thank you so much, Neil, for your kind words. Okay, your another question was by absolute numbers. I mean, number of shares was shareholders holding. Yeah. So yes, you're right. You're right. So you have to. Yes, the absolute numbers are more important than looking only at the percentage. Yes, that's you're right. That's you're right. Absolutely. I thought you are asking for that sum because that always remain 100%. Absolutely correct. So guys, any other doubts or I can take up the previous class this thing because I'm done with the security analysis. Okay, 3 hours we have studied about the security analysis, and in the next class we'll directly start with the technical analysis, which will be the second part of this. Okay, na? So let me share this slide now, the one which we just couldn't cover up because unfortunately I was not having this table with me. So guys, if you remember, this was our last class. I mean the first class, which was held on 29th October. Okay, so there I covered up a question on VAR. Okay, if you remember the concept of VAR. So this is what we have done. So that suppose you hold a 2 crore shares of a company and with this, and we are using the 99% confidence level. And how to use these value. So we were using the value of 2.33 on this. So three was student asked, from where did you get this value? So I said, ki, beta, I don't have a table right now. So I managed to put it in the Excel, in the PPT itself now. So you can see in the exam, if the question for VAR comes, you will be getting a table, although you will get the value, but still you should be knowing as a student that from where the values comes. So you have to see the value from cumulative normal distribution table. I told you now I will be explaining this complete table in the coming few topics that we are supposed to study. I will tell you what is a normal distribution table, what is two tail, what is one tail, what is level of confidence. Everything we will be covering up. I think security evaluation chapter, if I'm right. So I will be covering up that. Taking you to the point where from where do we supposed to see the value is. Since it is at 99% confidence level, I hope you can see this value. I'm sure it should not be very, very small. It's like if you are at a 99% confidence level, I told you to take the value as 2.33. So it is 2.3 and these are the values which is 0. Means this table is continuation of that. 1, 2 and 3. So I mean this table, okay, this value is coming here. So you have to see the respective value, 99% confidence level, you have to take 2.33. Let's say if the question in the exam comes as that you have to take the value from the 95% confidence level, okay? Not 99, but 95%. So from where will you search? Let's search here. Any 95 is there? 95, 95, 95.5, 95.05. This value. So which value will I take, beta? 4 and this is 5. So I will take the value as 1.65. For 99% confidence level, I will take up so it will be 1.65. Okay, so table you can download anywhere, Google or SFM books or any other statistical book. That's not a problem. So from there you will find this particular table and you will get such values for 99%, 2.33, which I took when I was discussing that question. In case the exam has 95% confidence level as the value, then you have to look at the table and the value will be 1.65. Okay, I hope I have able to cover up even the last class doubts. And one more student have asked, I think if I remember. Okay. Yes, thank you so much, Shalini, right? Your name is Shalini. Yeah. Thank you, Shalini. So one topic she's saying that, sir, decision tree analysis is to be explained in those techniques. So I will be covering up the decision tree in the technical analysis chapter. From there, you will understand. So although I've given you the explanation of trend analysis in the Excel, what is a decision tree? We have about this in the technical analysis chapter, which we'll cover up in the coming Thursday. So rest assured, I knew that I am yet to do that. So let me take up question of our student Lakshmi, I think. Lakshmi, she asked, now I'm taking our previous example question. She says, sir, in the last class this time we applied a formula to find out the variance of the daily change. Absolutely. Can't we take in place the formula, use the portfolio management formula, or the absolutely you can take that. You can take that. Okay, yes, you can, and it will work out. Yes, yes. So depending, see, formula you can apply anywhere. You can apply the standard deviation, you can apply variance, you can use the formula portfolio management of weighted standard deviation, not a problem. Depending, first of all, what all values are given to you. If the values are given to be applied in the formula, you are free to use those value, Lakshmi. Okay. Second thing is that you will use a portfolio management formula only when there is a portfolio. Portfolio means having two or more securities. So let's say if I'm saying you have three securities having weightage as 30, 30, 40, then you use the weighted average formula. But if in the question you have only one security, then weightage you cannot use. You'll use a straightforward formula for that. You can use that. Okay, guys, any other doubts? We have 3 minutes also. More. You have any doubts, you can ask me. I have completed the last session's value, which is 2.33. From where did I get that value? कहाँ से आई थी? I've shown the table. You can see that. Second, I've taken up your fundamental analysis chapter. Okay. Thursday we'll be starting off with the technical analysis, and I'll be explaining you the two things that I'm leaving, which is trends and the patterns, and secondly the decision tree analysis. That also I will cover up in the next class. Any other doubts, guys? Let me just refresh this. So, Neil is saying, sir, what is this 95% confidence level means? I think this we've already covered in the last class, that it's all about the percentage of the surety that you have. In the sense that, as I told you in the last class, that if you say that it will rain for sure. So I say, what is your surety? Kitni surety hai? What is the surety percentage that you have? So you say, sir, 90%. So that's your confidence level. So when you say it's your confidence level, you get nearer to the value. Means you get nearer to the table. The normal distribution table, the more confident you are, the more nearer to the table you are. The normal table, the that shaped one. Okay, this like a shape. So more confident you are at the better position. If you say no, sir, I'm not sure, I'm 95% confidence level, means I'm 95% sure. So you are away from the mean, which is 1.65. This is the interpretation of this. I hope that's clear, Neil. Okay. So thank you for being so proactive today. Great. You got up early and attended this session. Okay. So I think it's already 9:59. We can wait for another 30 seconds if any doubt comes. Otherwise, we'll end up this session with completing our first part. Any other question? If I missed out anything? Okay. So let me refresh that. Okay, so no other questions, guys. Thank you for being a very, very patient listener. I'm sure today's session must have been quite fruitful to you. The things which I showed you is again not relevant for exams at some stages, like correlation, regression, Excel sheets, but that is just prepared to develop your sense of understanding as to how you can analyze the company.
It's 10 o'clock.
Once you will analyze the company, then the second step will be to look at their charts and patterns, which is again their price and volume action, which will be covering up in the next class, which is Thursday. And I'm sure I'll be able to complete that chapter as well. Okay. So thank you so much, guys, for being very, very patient listener. If you have any feedbacks, please, you can post your question till 10:15. Anything. Some students said, sir, Zoom, you can zoom your table so that we can see the board. I'll do that. Any further improvisations is there, you please put over there till 10:15. Okay, and I'm really thankful for your patience listening and you being a great audience, I guess. Having less queries always means that a student is understanding the concepts. Okay, thank you, guys. I hope to see you soon on Thursday, same time, 7 a.m. morning. Okay, thank you, guys. जय जी, क्लोज कर दीजिए. हेलो जय जी. जय जी क्लोज कर दीजिए.